Reason for European markets to do anything different this morning, to come back to work after a 4-day holiday, having kind of done a lot of reading and tried to figure things out. I'm not sure how much more has been figured out.
I'm venturing to say very, very little. You mentioned BAE Systems. I've got my eye on Telecom Italia, actually. There's a Starlink story that I'm sure we'll talk about at some point. But this is preparing us for the market open here. Just a few seconds, markets are officially open. Not a huge amount of changes when you look at the FTSE 100. It is open, but again, marginal changes around the day, I guess. I mean,
that's very marginal.
Yeah, so there's nothing I can even say here.
So ASML is up a little bit this morning, which I still haven't actually put my finger on in terms of why that is. You are seeing some of the you are seeing some of the pharmaceutical names just giving back a little bit of ground. So GSK is weighing on the FTSE 100 this morning, but you've also got Sanofi down a little bit as well. Yeah. That feels a little bit more cautious in terms of this market. Vestas not reacting positively to the deal flow story we saw over the weekend. But you've got ASML up, Novo's tracking a little bit higher. To your point about the oil stock, Shell is tracking a little bit higher. Total's having a better morning as well. So there are kind of things, and Astra's actually just moved up as well. So it feels like a very mixed market. Again, looking at the single stocks, where's the clear narrative here? Is there a clear narrative which is moving things around? I can't see it from the sector point of view either. You are seeing maybe the basic resources popping a little bit higher. The oil stocks are on the move as well. So maybe there is a commodity theme. But again, where's the thing? The thing that has changed here, I don't think there really is one. It's interesting that the FTSE 100 is up by nearly 0.5% this morning, to your point about kind of maybe that negative stock story in the States yesterday. But you do have Shell tracking high, you do have BP up, you do have AstraZeneca up this morning. So it's easy to see why the FTSE on those three single names, at least, will be moving up.
The other ones I'll point out is the banks index. You are seeing kind of interspersed in terms of index contribution with some of the oil names. Some of the banks as well, HSBC, for example, Standard Chartered, Barclays higher this morning, even Lloyd's higher this morning, which is interesting because when you look at the actual bond market, there isn't that much of a move in yields. I'm wondering how much of that is an expectation on the back of that. But as you pointed out, Glencore, ASML, HSBC, your top movers this morning. To the downside, one of your favorites, though, Schneider Electric. This is part of your sensational six.
So this is the stock that everybody's paying attention to at the moment because it provides basically the network, not the networking gear, the infrastructure around the electricity that sort of provides the AI story. And I think a lot of people are looking for that second derivative, third derivative trade. Schneider keeps being mentioned potentially as one of those names. But yeah, not a massive move in the bond market. Interesting that you are seeing maybe a kind of a little tick higher, which kind of makes sense given what we've seen in terms of the ISM data. And I think this is going to be a problem that Europe is going to have, is that if we do see this divergence in terms of the economic data, to what extent is the transmission of rate cuts going to be muted, blunted in Europe by the fact that if the Fed wasn't going, you would see Treasury yields getting a lift?
That's a lot of domino effects I'm trying to kind of put it all together in my head, because the risk to all of that is you see some sort of spurt of growth in Europe, which I realize is unlikely, but isn't that exactly what people said about the States? And I can recognize that, of course, the EU and the United States is different.
Yeah, in the same way.
Yeah, at a time when you are starting to see, I think there was a story over the weekend that balance sheets were kind of shrinking in a lot of European currencies as well, or countries, excuse me, as well, off the back of some of the kind of bonds maturing, and that makes a lot of sense. You got to bring them into the credit story as well. But European growth it's not weakening to the same extent that I think a lot of people expected it would. There is no dramatic downfall.
So that's true. But I guess the problem would be if, say, the Fed, Mark Cudmore, He doesn't see the Fed cutting at all this year. We're getting a no landing. So the Fed does not cut, and the European economy still doesn't look great, and you've got the Bank of England and the ECB forced to cut.
Yeah.
That divergence is going to be very dramatic in terms of what you're going to see likely priced into euro, dollar, sterling, whatever else is going on.
Doesn't it just make the trades easier, though? Isn't that just a no-brainer trade?
It would be a very easy dollar positive trade, and I think that would be the interesting thing. So it can come down to timing. Now, June, July, I don't think is going to make much difference, but Anna Boata at Allianz talking to us earlier about the fact that she thinks actually the Fed will punt maybe a little longer, and we could see maybe a July cut rather than the June cut.
We had, for 6 months now, a call for June, which we moved to July. And clearly, we still see signs of having that 25 basis points first rate cut in July. Clearly, the Fed has suggested that we don't need to be at 2% inflation rate in order to cut interest rates. And we do believe that inflation will go to 2% at the end of summer, early autumn.
So it's interesting. You are seeing the read across from the US strong data yesterday into European bonds this morning. Take a look at what's happening in the gilt market this morning. Big move, despite the fact that you see BRC data suggesting that actually shop price inflation is coming down very rapidly, yet yields are higher. That's the gravitational effect that the US market is having. Thanos Mountakidis joins us now, global head of G10 FX strategy, joining us from Bank of America Global Research. Morning.
Good morning.
The dollar story is going to get potentially very interesting here. And we got a 107 handle on euro dollar. You've got US data that is looking really strong right now. You've got the JOLTS data later on today, but you've had ISM suggesting that actually the US manufacturing sector is picking up. You've had an idea that maybe the dollar weakens from here. Is that now being called into question? Kind of where are you questioning? Are you worried that actually we could see a significant dollar strength here rather than dollar weakness?
We have been expecting a strong dollar early in the year because the market was pricing too many cuts too early. Eventually, by the end of the year, we have a weaker dollar, but based on two assumptions. First, the US economy will slow, and second, related to that, the Fed will start cutting rates. Obviously, the risk is that it will take longer. The US economy has been very resilient. Inflation has been sticky. And particularly with the labor market so strong, there is no reason for the Fed to start cutting early. Even if they start, every cut afterwards will be data dependent. It will not be a normal easing cycle. So there is a risk, as long as the US economy remains in a non-landing scenario, that it will take longer.
How big a risk is there? You have this at the end of the... Where do you have us at the end of the year?
We have it actually euro-dollar 107 for the first quarter, 110 for the second, 115 by the end of the year. This is still, 115 is halfway towards the long-term equilibrium 120, and this assumes that we get 3 cuts by the Fed this year, which obviously is not a given.
Okay, so as we work our way towards that, is the risk growing now that we don't get that? That actually the risk is that potentially the Fed doesn't cut, or we get very few cuts, maybe 1 cut, according to Bostic, and we see 2 or 3 cuts coming through from the ECB. In that scenario, isn't there a greater move potentially? You could see a move down to 105, 103, potentially parity. How big a risk is there on that front?
Yeah. If we're in a scenario in which no central bank cuts this year, then we can see euro-dollar 105. If the Fed does not cut, but the ECB and other central banks cut, then we can go to parity. If we have new shocks, an oil price shock, even if no central bank cuts, we can go below parity. So these are roughly the forecasts.
You said 115 by the end of the year to come in line with the 120 long-term average. Why 115 by the end of the year? I can appreciate that it is a American-driven story by that, but doesn't that create just this massive dislocation on the European front, especially when comparing to the long-term average of 120, when some would argue, critics of that would argue, that if you look at the last 10, 15 years of European economics, it wouldn't necessarily favor 120. It would favor something weaker than that.
I mean, our baseline assumes that we get some slowing of growth in the US and that the Fed cuts matter more than the ECB cuts. But we also have the US economy still growing much faster than the Eurozone economy.
Yeah.
Now, if we're in a scenario in which, as the US economy starts to slow, the European economy starts surprising to the upside, then we can go closer to the 120 equilibrium.
What is the likelihood of the European economy surprising to the upside, though?
Not very high, but having said that, recent data has been somewhat better. From a very low base,
Yeah.
but has been somewhat better.
So not very high, but you're still expecting the long-term average to kick back in. Why is that?
The Fed starting to cut rates is a big deal because the Fed cuts have global implications. But given that the US economy is resilient, the risk is that it will take longer and we're going to have a very shallow easing cycle even when it starts.
A European central bank's going to have a problem. This morning, so BRC data comes out, shows the fact that the UK grocery price inflation is falling really rapidly. Yet what do we see? We see gilt yields at a 10-year tenor ticking higher. Is there a danger that actually we don't see rate cuts that are delivered in Europe being transmitted to the economy because the Fed is going to wait and US rates are going to stay higher and term premium is going to be higher in the States because we're all increasingly worried also about the deficit and what is happening with the debt load as well? How big a problem is there going to be in terms of the disconnect between what happens in Europe in terms of policy and in the United States and how that relates to the rates market?
There are two issues here. First, rates markets are strongly correlated. So whenever the market prices the Fed, it reprices everybody else. Second, even though European inflation has been falling faster, we're still above the target, and the labor market, both in the Eurozone and the UK, is still extremely stretched. So even if the ECB and the Bank of England start to cut before the Fed, they are likely to be very cautious simply because they are dealing with a labor market that is very tight and wages are increasing. So they will continue actually being data dependent. It will not be a normal easing cycle.
You go. I'm still processing.
Okay. Okay. So let's talk about sterling. Let's talk about sterling a little bit. The governor seems very keen, and I wonder whether Jay Powell provided him with cover. I was fascinated to see the timing between what Jay Powell said and the governor's FT interview, where he talks about the fact that he has a predisposition to cutting. He wants to cut. He sounded much more confident in his ability to cut. If Powell turns around and says, actually, the data probably means that we're going to cut later, how does the language change in Europe? How quickly does the language change in Europe? Are we going to have a communication crisis as well, where central banks in Europe get kind of left high and dry by what the Fed does?
I think both the Bank of England and the ECB will make the point very strongly that they don't depend on the Fed, but the market will doubt that this is the case. Now,
how do they communicate? That becomes incredible at some point.
It will be a challenge for them to do so. They do have different policy reaction functions. In the case of the UK, although inflation remains higher than in most of the rest of G10, it is falling faster, particularly given what was going on last year. In the case of the Eurozone, inflation is much lower than in the US. The data is weaker. But the ECB is more hawkish for a number of reasons. So they want more evidence that they're approaching the 2% inflation target. Yep. And again, they focus a lot on wages, rightly so, because despite what's going on in the rest of the economy, if the labor market remains tight, the unemployment rate is stuck at an all-time low, wages keep increasing, they have to be very cautious.
We're talking a lot about the labor market in the States and in Europe. I'd like to talk about the labor market in Japan in particular. We're talking a lot about this low FX volatility that's still kind of game theorying what happens with the ECB, what happens with the Fed. In the meantime, while we're waiting for some sort of real decisive direction from either central bank, is the BOJ more in focus? Is the carry trade with the yen still the go-to trade, and how long will that be in vogue?
Now, Japan is a completely different case. Inflation there is a solution, is not a problem. They are happy to see persistent inflation. It is above the target, but not that much higher. And they have a long history of 30 years of deflation.
Yeah.
They managed to exit their conventional policies without actually causing a market panic. If anything, actually, it didn't really look like an exit. So we think that they will remain very cautious, leaning on the other direction compared to other central banks. And to a large extent, dollar-yen depends on the Fed. If the Fed does not cut rates, dollar-yen can go to 160. If the Fed starts cutting rates, it can go to 142.
How big a risk is there of intervention near term, today, tomorrow? That's a scenario that may emerge over the next few weeks, months. How much pressure is there potentially at the moment for the Bank of Japan, Ministry of Finance, to do something in the near term? And is the market ready for that risk?
I think it is expected. I think it is very likely, but it will be more like leaning against the wind. They know very well also from past experience that these interventions, they don't work. It's mostly a threat so that they will create some caution in the market, some two-way risk. But I think they know very well that everything depends on the Fed. If they just buy some time with the intervention until the Fed starts to cut rates, it will be fine. But if the Fed does not cut this year, there is nothing these interventions can do.
But you said if the Fed does, you could see dollar-yen at 160. What levels do the risk of intervention increase at? I've seen numbers anywhere from 152 to 155. What numbers are you looking at?
I think 152 is a critical level at this point where we will expect intervention in the scenario in which they do expect the Fed to start cutting this year. But if the market prices no cuts for this year by the Fed, they will realize that the level will be higher. So they will be more flexible in this case, as long as it is driven by forces that are external to Japan.
Let's see this morning. Thanks for joining us. Thanos Mourkides, Global Head of G10FX, joining us from Bank of America Research. Quick look at the core six here in Europe to see what's kind of happening there, to see what's going on with the main stocks that we focus on. Little weakness in Ferrari this morning, which I think is interesting. But elsewhere, you do see Novo Nordisk rising. You do see LVMH on the front foot. ASML is also significantly higher. So generally, European markets feel much more on the front foot than you would have surmised maybe by looking at the price action coming out of the US yesterday. Let's dig further into the individual stocks. Joe's here with the details.
So UBS shares actually pretty much little change now, up 0.2%. This stock up 48% over the past 12 months. This news of a $2 billion buyback perhaps already priced into the market, given what we're seeing with that stock, little change. It actually slipped slightly at the open. One stock that's dropping pretty sharply is Vestas, down 3%, was down a bit more than that. The weakness in the orders is what analysts are pointing to, around $1.9 billion of orders in the quarter, but that is below expectations. We brought up Telecom Italia, a bit of a row, interestingly, with Elon Musk, Starlink accusing Telecom Italia of withholding data that the company needs to roll out its high-speed internet in Italy. So that is interesting. We're waiting to see any further declines in that one. Down 1% at the moment, so a pretty decent move. But the big dropper today is Superdry. Take a look at that one, down 50% as the founder, Julian Dunkerton, announces that he won't now make a bid for the company. That had been the key prospect for the firm, and they're talking about potentially a discounted share placing in order to give the fashion retailer some of the cash that it needs. As we said in Stocks to Watch, that stock used to trade at £20 a share. It's now trading at 14 pence. You can see the demise of that stock quite clearly. We'll take a look at some chip stocks as well, because there's a couple of bits of news in this. Firstly, we've got a report that Samsung is potentially lifting the prices of some of its computer drives around 25%, according to reports. ASML gets 20% or more of its revenue from Samsung alone. We're seeing a gain there. Also, BE Semi has a broker upgrade over at Barclays, and a couple of other positive stocks, Infineon, ST Micro. The other thing we're seeing is a report of OpenAI potentially building a massive data center with their investor Microsoft. That would potentially be used for their OpenAI ChatGPT rollout, according to reports. We'll wait to confirm some of that one, but positive in terms of those shares today. In terms of the UK, it is all about those gilt yields that you mentioned. We're reopening after that big move higher, around 10 basis points in the Treasury yields yesterday following that US data, and as such, we're seeing Persimmon and Taylor Wimpey declining, and home builders also had that data showing UK house prices declined. And similarly, we had data showing retail prices also slipped as well. So brought up Tesco and Next, but a bit of a move lower in the home builders today for those gilt moves and also that house price data. In terms of your morning calls, going to bring up RWE, this one out of Germany. It's downgraded by Exane BNP. It's had a terrible run, this stock, with energy prices coming down, and Exane is bailing on their buy rating today and sending the stock lower by around 0.9% once again. And a final one is Barclays. We're doing the UBS buyback, obviously, but another one to keep an eye on in terms of Barclays is this one. This is a buyback-driven story. Jefferies given the stock a street-high target. Believe it, there it is, 330 pence a share. The stock trading at 185. Massive gains expected, according to Jefferies. They could return £11 billion worth of cash to shareholders over the next 3 years, and they give it a street-high target, and that one is up 0.8% today.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers. Coming up on the program, Tesla may be headed for a gloomy milestone as waning demand for EVs takes its toll on their sales. That story next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Tuesday, the 2nd of April, welcome back. Actually, I think equity markets aren't where the story is this morning. You've got equity markets broadly rising, which I think is interesting in the light of what we saw yesterday over in the United States, where we saw some weakness given what we saw with the data. This is understandable. The data suggests maybe some strength, actually, in manufacturing, which means rates maybe stay higher for longer, which means potentially that's bad news for equities. What you are seeing this morning, I think, in Europe, which is interesting, is a big move in the bond markets. So you're seeing yields sharply higher, despite the fact that actually the data are pointing to weaker inflation. Let's talk a little bit about some of the single stocks that we're going to be watching throughout the day. Keep an eye on the auto sector. Tesla is going to be a big focus of attention, maybe heading for a gloomy milestone as waning demand for EVs, electric vehicles, and elevated interest rates maybe continue to put a downward pressure on some of these sales. Analysts have been rapidly lowering their projections ahead of this week's deliveries report. Joining us now is Bloomberg's Craig Trudell. Craig, last year we were shooting for the moon. The story was amazing. Everybody was pricing the stock sharply higher, but we were starting to get early indications that actually maybe sales weren't as strong as anticipated. We're now getting strong confirmation of that, and the stock has reacted. What are we going to get that adds to that story today?
Yeah, I think what we're seeing is broadly payback in the sense that the stock performed so well last year despite some weakening of fundamentals. and some payback in the terms of just operationally. This was a company that slashed its prices at just an unprecedented rate last year. And it's just something you don't see. You don't see a company that has a really strong selling model like the Model Y make that 20, 25, 30% cheaper in the course of a year. And so, the way that they sort of pushed on a string last year to juice sales, how much can you continue to do that, sustain that when you have, fleet purchasers that are going to balk at buying in the future when you've, essentially nuked the resale values of the vehicles they have in their fleets. And so we're seeing, it was remarkable as the quarter was coming to a close, just how much consensus was coming down. I think my favorite example here is Deutsche Bank, where they started the month of March at 476,000 was what they were expecting. They took that down to 427 on March 11th, and then just last week took it down further to 414. Wow. So the amount of sort of dramatic moves by these analysts was not something like I've seen before.
Where's the pressure points, though, in scaling up? You mentioned that kind of more affordable model as well. Where's the hiccup there? Is it a supply-driven hiccup? Is it a marketing-driven hiccup? What is it?
I think what was really interesting in the Walter Isaacson biography that published late last year was you had indications that Musk's team was kind of having to press him on, we need a cheaper model. And it was kind of a remarkable bit of writing in the sense that Musk himself talked about a $25,000 Tesla years ago. Yeah. At the 2020 battery day, he was talking about that being something that was in the works. And then it kind of got put on the back burner. He had kind of convinced himself that Tesla was going to be able to bring a driverless car to market. So why worry about, building out the lineup if they're on the verge of this, hugely, game-changing technological development? The fact that, the driver assistance system may be very competitive, but it is not capable of driving the car without you supervising it. And therefore, it's not fundamentally changing the industry like he hoped.
BYD, Xiaomi, Chinese manufacturers pushing ahead, like you've seen the sales coming through from BYD, that they are getting stronger and stronger and stronger. Now, they may be being juiced by discounts as well, but there must be an implication for Tesla.
Absolutely. And so this is a case where, in any other sort of situation, you would perhaps lean on exports. But we find ourselves also in a very difficult position in terms of, here in the EU, we're going to likely see in the next few months increase in tariffs. Yeah. And so there's, not a whole lot of options here other than to continue to compete on price, which is what we're seeing across the industry. We've seen what that's done to margins for Tesla, and it has not been
Greg,
good.
Yeah, certainly. Big impact. Craig, thanks very much indeed. We'll look for that data a little bit later on. Coming up, we're going to be talking about what is happening with the UK house price story. The head of UK residential research, Knight Frank, is going to be joining us. Nationwide data. Maybe we're starting to see a little bit of a tick up, but it's going to be slow. It could be a bit of a grind, but at least potentially maybe it's moving in the right direction, certainly from a housing point of view. That's next. This is Bloomberg.
In tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be
based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Nobody brings you top names like Bloomberg.
The expectation that interest rates are going down is creating animal spirits again.
Bloomberg. Context changes everything.
This is Markets Today. We're about 30 minutes into the European trading day now. The stock market it's in the green, but there isn't anything really driving it. Some would argue it's a little bit of still processing some of the news that we got out of the States yesterday. One notable outperformer driving the FTSE 100 higher is going to be the banks index. That seems to be more a result of what you're seeing in the bond market than the stock market, especially when you have gilt yields higher by 11 basis points. The U.S. Treasury market not doing a whole lot, but perhaps processing some of the data that we got yesterday.
We saw the ISM print yesterday come through, particularly the prices paid component within that data, telling us that actually you are seeing a re-emergence of manufacturing inflation in the States. And the manufacturing data is picking up. Tim Fiore, who runs that data series, has been talking about this for a while. He talks about us bumping along the bottom, but we're now starting to re-accelerate. And there's an interesting inventory story around that. It just pushes the Fed out, doesn't it? And I think it's going to be a real challenge for the gilt market, for the bond market, just to deal with this idea that maybe we do see divergences across the Atlantic. And you're still going to see that big gravitational effect coming through for gilts off the treasuries. And that's going to be a problem, I think, for the Bank of England and the ECB.
So I can put together the read-through from the Treasury market yesterday into the gilts market today. What I can't put together is why the Treasury market reacted so aggressively to this ISM data to begin with, especially when, to your point, yes, it's a kind of move higher in the manufacturing data, but it is still manufacturing data in the States, which is less of a read-through into the general economy.
I think it was the prices paid bit that I think maybe caught people's eye. The fact that you are starting to see that inflation rate ticking higher again. The whole idea is that we're seeing disinflation, and that is being led by the manufacturing sector. If even the manufacturing sector is starting to see a re-acceleration of inflation, then that's maybe slightly more problematic.
No, absolutely. It's just that there's a reason people brush off this data, and there's a reason there isn't always this knee-jerk reaction on it.
I think it used to come out at the beginning of my last show every day. Every time I saw it, I was always surprised how big a reaction there was, particularly to the prices paid bit. That's the bit that seems to have been, and the labour market data as well. Those are the two kind of areas.
The fact that the employment numbers are factored into that data.
Yeah, exactly. Here in the UK, I think it's a different narrative. So inflation, it's interesting to see what's happening with the inflation data. So UK store data dropping to 1.3% in March. This is the BRC data compared with 2.5 in the previous month. So this is data we get from the British Retail Consortium. So this isn't frontline headline inflation data, but it is the lowest level since December 2021, before inflation started to ramp up as a result of the Russian invasion of Ukraine and how that hit food prices, etc. Now, what is the other aspect to this is that what you have seen this week as well is the minimum wage going higher. You're also seeing fuel prices going higher. These are input costs that the big grocers here in the UK are going to have to deal with. So does this data continue its downward trajectory, or does the cost story put a floor underneath it that are ultimately going to be passed on to consumers? Sam Unstead joins us today from the Markets Today live blog. That's the interesting conundrum here, really, isn't it? We've seen inflation coming down, but you do wonder whether that's going to be continuing. Actually, I wonder whether the bigger story actually this week on the inflation front is what's happening with the minimum wage.
Yeah, so that's a really, so the BRC data, I think, gives you, you're sort of saying it's not this overarching data, but what it gives you is this nice information as to how that food price data is coming down, right? So food prices are coming down anyway, so you get a combination of inflation on there coming lower, but also this intense competition between grocers. And with this report almost every month, that is one of the key driving factors. So as you say, those input costs are going up. Now for the grocers, most of them have already put their wages up, so they are going to face a little bit of an extra cost on that, but not a huge amount. But their suppliers, exactly. And then also there is a limit to how much more they can cut. They're already operating on very, very thin margins. And so there is a limit to how much further that can go down. And so I think as you reach, particularly to the middle of the year, you may see that slow a little bit.
This move that you're seeing in the bond market, though, this gilt story, is this a catch-up trade to yesterday, or is this reacting to the data you just laid out?
I think it's a catch-up trade, yeah. And I think, something to note as well with the FTSE 100, you mentioned banks already, but one of the things pushing the FTSE 100 today as well is the commodities story. This is the thing that, the exposure of the FTSE 100 has to oil companies, mining companies, has held it back from keeping up with the records that you've seen in Europe and in the US. But today, and actually, just generally in the last couple of weeks, as the story particularly on iron ore and copper has got a little bit brighter, and as oil has continued to sneak higher, that's kind of what's pushing the FTSE 100 today.
Net, though, are we going to end up in a situation where the Bank of England is looking at inflation data that is coming down, that has come down, is predisposed, therefore, to cut, despite what Haskell and Mann are saying, and actually the transmission through to the real economy is going to be blunted because of what is happening with the Treasury markets? Is that going to be a scenario that potentially we could be heading towards here, that... yeah, the Bank of England cuts, the front end moves, but actually the shape of the curve really sort of moves off the back of that because longer dated bonds, longer dated gilts here in the UK are really responding to what's happening in DC.
Yeah, and I think that's been the story, and I think that's going to continue to be the story with gilts in particular. So the question and the sort of debate that has been raging really in the last couple of weeks is whether the Bank of England is going to lag or whether it's going to cut first, right? If they do lag the Fed, that's going to continue that story. The gilt markets in particular are going to continue basically to move with Treasuries rather than really on what the Bank of England is doing itself.
Should the gilt market and the Bank of England as an extension be paying more attention to the housing story here as opposed to what's happening in the States?
I think so. I mean, the housing market data we got this morning, the nationwide data, I think shows a market that's sort of slowing, right? It's sort of stagnating a little bit. And I think until you get that rate cut and mortgage rates start to come down a little bit, it's not really going to turn around enormously. But yeah, I think they should be paying perhaps a little bit more attention, particularly on the mortgage side of things.
Sam, great stuff. Thank you very much indeed. Sam Unstead from our Markets Today blog. You can get more on what is happening on that blog. All you got to do is go to the terminal or go to the website. TLIV is the function on the Bloomberg. Let's carry on with that data and figure out exactly what it means. The nationwide data today pointing to maybe stagnation. There had been an expectation that maybe actually house prices would continue to tick a little bit higher, but what we're doing effectively is flatlining now. Maybe the weather's got something to do with that. Maybe it's mortgage rates. That's probably more likely. Tom Bill, head of the UK residential research team over at Knight Frank, joins us now. Morning.
Good morning.
We have seen an impact through into the mortgage market that has been difficult, I think, to discern into housing. So mortgage rates have been sort of bumping around all over the place. People haven't quite known what they're doing, therefore, with what they're going to be getting, and maybe that's now starting to show up in the data. Is that the obvious kind of conclusion from what we've seen today with the nationwide numbers?
I'd say that's probably correct in terms of what's happening around the mortgage market data, also what's happening with the wider economy. We've had mixed signals around inflation over the last few months. I think at the turn of the year, financial markets got fairly excited that we'd have 5 rate cuts this year, and I think that's since calmed back down as underlying inflation has proved more stubborn than people wanted. And I think it's sent mixed messages to buyers and sellers at the moment in the markets. Half of them are probably thinking, well, things are getting better, and the other half are thinking things are sort of still getting a bit worse. And that's probably created a certain amount of friction around prices and asking prices. So it's a bit of a mixed picture, but overall, as we saw today with the data, it's fairly unexciting in the first few months of this year. We still sort of get the sense that we're waiting for something to happen.
How big is the spread between bid and ask at the moment? In terms of the sentiment, I should be selling my house for this, I want to be buying that house for that.
Yeah, you'll probably find it's in double digits in many
Wow.
areas.
Okay.
I would say. I think it's the old story about do you go on at a high price or do you go on at a price where you attract competitive bidding and things get bid up. That's a sort of the debate that buyers and sellers will be having. But at the moment, I think the prices in general are kind of going sideways. If anything, they're not really going up.
Just in terms of that, when houses go on the market, there's limited supply right now. Is there a lot of bids for those houses, which should in theory push prices up? Or are people being constrained in their ability to bid higher because they're worried about the mortgage rate that they will ultimately be paying?
I think both those things are putting downwards pressure on prices. So banks are wanting to lend. They're frustrated by what's happening in swap market because they can't lend after a quiet year in 23.
Yep.
We're seeing more supply now starting to come through, actually, because at the start of the year, people got a bit more positive and supply started to pick up. So more supply, slightly higher mortgage rates has really calmed down, I think, demand over recent weeks. So I think that hence that bit of friction that's come in. You've got more people rolling off relatively favourable two-year fixed rate mortgages that were agreed at the start of 2022. So everything's combining to make things a bit sticky at the moment for the housing market.
So you're talking about this kind of stagnation, the sideways movement. What breaks us out of that?
I think it's some certainty. The guessing game over when the first rate cut comes, I think, has to kind of end. And I think we have some certainty, and lenders have some certainty that something's coming in May or in June, wherever it is. And then we'll start to see mortgage rates respond. And I think the market at the moment is really responding to what's happening in the mortgage market.
So what's the lag there between that clarity or indication or sensitivity around the data, for example, and the mortgage story? Do you start to see, because of the lack of direction at the moment, that lag extend?
I think the lags, well, we all know how long it takes to move house. I think the lag, you should start to see the data come through initially in pricing, and that'll take its time to work its way through the system, and eventually transactions will pick up. I think a lot of people have missed the story of this downturn, which has been a fall in transaction numbers, quite a steep fall. Prices haven't done very much. People are taking out longer mortgages. The jobs market's been fairly strong. Transactions have fallen actually pretty steeply compared to the sort of longer-term average, and they are the thing that's slowly starting to pick back up again. So it's a normalization, but it's sort of painfully slow at the moment.
Are we is there going to be a long period in which prices go sideways? In order to we saw a very strong market in and around the pandemic. Prices picked up really sharply. There was a lack of supply. People were trying to move in that period and were bidding up prices.
Yeah.
Is this just the hangover effect from that? And if it is the hangover, how long could that last for?
I don't think we're going to see double-digit price growth anytime soon. I think you had a stamp duty holiday as well, which really drove a lot of activity. And a lot will depend on that broader fiscal kind of environment for the market and what the government does ahead of the election. Does it stimulate the market with some demand-side measures? But I think generally speaking, we're not expecting meaningful single-digit or even double-digit growth. So,
is there going to be a permanent effect on psychology? There was a long period of time when interest rates came down, that people got used to the idea that they didn't see volatility, that there wasn't that kind of pain associated with potentially being hit with a much higher mortgage bill at some point at the end of your fix or whatever that was. Do you think that is a permanent shift in terms of psychology, or a more medium-term shift in psychology that will have a profound impact on the market?
I think it's more short to medium term. I think we're going to see most of that pain come through this year. We're kind of almost at the moment at peak pain, because as I say, those 2-year fixes.
People learned the lesson.
I think people just want stability. So where they see mortgage rates settle at 3.5%, and they don't believe that they're going to fall or rise meanefully, I think you will see the market start to pick up.
So previously you'd stretch because the housing market was rising, you would stretch yourself, therefore you would take on more risk. If we see a period of stability, are we going to see that kind of desire to stretch yourself going to be there? And if there is now this kind of understanding that at the end of the fix you can face a higher cost, that you don't stretch as hard as you would have done in previous cycles?
I think everything about human nature that we know and financial markets means I think people will stretch themselves. And I think they will do that and push themselves to the limit. And I think this year, if things stabilise and people aren't expecting to come off their fixed rate with get a higher rate, then I think people demand will pick up accordingly.
And is there any expectation that supply changes if we get a Labour government?
Supply?
New build supply.
Governments, politicians routinely overestimate, I think, their ability to affect how many houses are delivered. So I don't see any particular change in terms of the government changing colour around the supply of housing.
So no shift in planning policy, no major changes?
There could be tweaks to the planning system, but how much that affects how many houses are delivered, I think, is a very open question.
Okay. we're going sideways for quite a while. Certainly seems to be the message at the moment. Tom Greatsey, thanks very much for stopping by and interpreting the data for us. Tom Bill, head of UK residential research, Resi Research over at Knight Frank. Lines out of Germany.
Lines out of Germany. We were expecting this coming up at about 9 a.m. It looks like it's come out a little bit early. The Germany Lower Saxony March consumer prices riding about 0.5% on a month-over-month basis. On a yearly basis, about 2%. Slight uptick in euro-dollar. It doesn't look like the markets are reacting too strongly to this, but 107.37 is what we have on that story. We're going to dive into those numbers and the broader European inflation story in just a few moments. We're going to discuss not just these numbers, but what we have coming up later today and later in the week. That coming up next. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley.
It's Jobs Day, and Bloomberg has the report under surveillance.
Job numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
This is Marcus Dewey. We're about 47 minutes into the European trading day. Green on the screen of the European indexes, but some breaking headlines crossing the Bloomberg terminal right now as we get more inflation data, this time coming out of Italy, and a hot number as we kind of saw in the U.S. as well. Let me break it down for you. We are seeing numbers, manufacturing PMI rising to 50.4. The estimate was 48.8. Some pretty big
Another strong manufacturing number.
Yeah.
What did we see yesterday out of the United States? A strong manufacturing number. I wonder whether or not we're going to see a little bit of a manufacturing renaissance here. Italy clearly has been juicing its economy in the way that others haven't from the fiscal point of view. Is that a read across as well?
Arguably so is the U.S., though.
Yeah, no, definitely.
Yeah.
You could make an easy comparison between what's happening. What you're not seeing is that in Germany, which I think is where maybe you're seeing the laggard kind of effect coming through. So I think it's a positive number. It speaks to this idea: is this an economy that needs rate cuts? Does the Italian economy need rate cuts right now?
That's something I don't think anyone's ever asked in the history of Italy. I have to say, I'm curious about getting a little bit more insight here. Let's bring in a true expert. David Powell joins us on set from Bloomberg Economics. What do you make of these numbers? Is this just a purely fiscal impulse, or is there more to it here?
Well, the Italian economy, much like the broader euro area economy, is probably going to be gaining some momentum this year. With inflation having coming down, people's real incomes are going to be up. They're going to be able to buy more, and that's going to help across the board. Of course, you mentioned the weakness in Germany. Germany is more exposed to high interest rates through its manufacturing sector, which produces a lot of investment goods, than Italy is. So it's no big surprise that Germany remains a laggard in this environment relative to other euro area countries.
Inflation, though, we're going to see a lot of inflation data over the next few kind of minutes. Inflation data in the Eurozone points to the idea, though, that maybe the inflation dragon has been slayed. What is it going to take for the ECB to be convinced of that? And how convinced does it have to be, particularly with this idea that the US economy maybe doesn't look like it's coming in for a landing? Do you think does that change the narrative in terms of the way that the ECB is going to be thinking about its level of conviction that it has inflation under control?
Well, the ECB, over the course of kind of the last year or so, has moved the goalposts. They were focusing on headline inflation for a long time, and then they said core inflation, then core inflation came down, and now their big focus is wage growth, and that's what they're looking at right now in order to cut interest rates. Fortunately, that is decelerating, and it's not come down as much as they would like, but that's probably going to come down more over the course of the next couple of quarters. And the euro area is a very different place right now than the U.S. When we look back to last year, for example, the euro economy did not expand at all, and the U.S. economy expanded by 3%. So they're not in the same league right now. The U.S. economy is much stronger than the European economy, which has hardly expanded for nearly a year and a half now.
So we've talked about the U.S., Italy, Germany. Let's bring in one more country into the mix. There's getting French PMI data out as well for the March numbers. 46.2 is the numbers coming in. The preliminary estimate was 45.8. What is going on in France? How does it differ from the manufacturing story in Germany?
Well, the German economy is much more dependent on manufacturing than the French economy. So the services sector is probably going to be boosted most by the boost to real consumption as inflation comes down, and that's going to help France a bit more than Germany. But broadly speaking, the economies of the euro area are highly correlated. Their performance is similar from one country to the next, and they affect each other. And what we're seeing here is probably going to be this year a broad improvement. It's not going to be a huge improvement, but they're kind of broadly, slowly gaining momentum.
Are we going to see a transmission problem in Europe? If US rates stay high and the ECB, the Bank of England, etc., cut rates, we've already seen the SNB obviously make that move. Is the effect of those rate cuts going to be blunted by the fact that US rates, which exerts quite a big gravitational effect over European bond markets, if they stay high, European bond markets yields don't come down as much? If we do need to see rate cuts in Europe, are the effects going to be limited, and therefore is there the potential for actually the ECB, the Bank of England, going to have to do more to get the same effect into their economies?
Well, what really matters for the economy is the interest rates that businesses and households face when they want to take out loans for various reasons. And what we saw on the way up when the ECB was hiking was that these rates were being the rate hikes were being almost fully transmitted into rates that are available at banks. We've got data on that from the ECB. And so there's no reason to think the transmission isn't going to work just as easily on the way down and be felt throughout the economy, giving businesses and consumers some relief.
Well, then let's talk about the contagion, if we can, though. In just a few minutes, I believe we're also going to get those final manufacturing PMI readings out of Germany as well, on top of the data deluge that we've got in the last couple of minutes. the conversation has arguably been, is Germany the sick man of Europe? It's quite clear that they're underperforming on the data front, on the economic front, you name it. At what point are the other European economies that are showing strength right now affected?
I mean, I think we shouldn't exaggerate the picture either. It's not like Germany's this case of extreme weakness and the other economies are booming. Germany is a bit weaker than the other economies, but there is a broad-based weakness across the euro area that has come about as the ECB has hiked interest rates at the fastest pace in its short history. You know, the only problem is that's probably been a bit more difficult in Germany because of its exposure to industries that are very cyclical, much more so than the other economies, which have larger services sectors, and the services sector is just less affected by higher interest rates because people still need a haircut and still buy consumption goods and things like that when interest rates go up. But what they don't do is they say, oh, maybe I don't need a new car right now. I can wait until next year when interest rates go down. Or if a big company wants to buy some big machinery or something, they go, oh, well, maybe I can wait until interest rates come down. And that's really what's plaguing Germany at this stage.
A lot to digest there. David Powell, Senior Euro Area Economist over at Bloomberg Economics. We thank you so much for breaking down really just every data point across Europe that we just threw at him. In addition to some of the data points that we're going to be waiting for in just the next 30 seconds, let's take a quick look at what's coming up in the week ahead. That Germany CPI number, as I mentioned, the March prelim numbers are coming out shortly. Plus those Fed speakers, Bowman, Williams, Mester, and Daly, all looking to speak on Wednesday. You've got the NATO foreign ministers meeting, the Euro area CPI numbers, some March preliminary data there, as well as Fed Chair Jerome Powell speaking on the U.S. economic outlook. On Thursday, more Fed speakers, Harker, Barkin, Goolsbee, Mester, and Kashgari. We should mention some of these speakers are speaking twice in 1 week, so that is worth
anybody
mentioning.
Not speaking?
I haven't gone down the checklist, and I haven't done a quick attendance check by everyone, but maybe we'll do that on Friday.
Yeah.
U.S. initial jobless claims that day as well. We should mention it's also the 75th anniversary of NATO as well. And on Friday, U.S. payrolls and jobs data, the 35th Ambrosetti event kicking off on the shores of Lake Como. I believe our very own Francine Lacqua will be there. And on top of that, the EU and the United States meeting for their Tech Council meeting. So there's actually a lot going on in the monetary policy space and the geopolitics as well.
We've got a bit more data coming out. March manufacturing PMI, these are the final numbers. You get 41.9 out of Germany, 41.6, the preliminary number. I think that's a very small difference. The fact that it's got a 41 handle still tells you everything you need to know, to your point about what's happening with German manufacturing right now. Yeah, it looks, this week is going to be, this week has the potential for a little bit of volatility. I'm genuinely fascinated to see, A, how the European data comes through, but B, how coalesced is the FOMC in terms of the idea that we will see a June rate cut? And if we're not, then potentially a bit more pricing still to come through in both sides of the Atlantic's bond market.
I mean, pricing to come through, but then also I wonder if you start to see that divergence, do people just look at it and say, hey, we're not going to touch it? Is that reason to not engage or to have even less volatility than what we're seeing right now? I could see a kind of wait-and-see approach.
Absolutely.
After this conversation.
So a lot of Fed speak. Jolts are coming out a little bit later on today. We've got payroll data coming out on Friday as well. It's actually quite a busy week, and I think the geopolitics is something, to your point that you made at the beginning of the program, is not something we can ignore either. How does Iran react to the attacks that we've just seen? Is that something that ultimately could impact oil prices as well? Were you to see potentially an attack on Saudi oil facilities, for instance? That's something that the market is not discounting right now.
Not discounting. There's hedges in play. Is gold a hedge story? Is gold something else? We don't really know. But I'm sure it'll all shake out. To me, it's the theorizing behind the Fed speak for me. That does it for markets today. The Pulse is up next. Stick with us. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole, ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
And market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Kriti Gupta in London with the conversations that matter. Here's what's coming up on today's program. European yields higher as investors wake up to America's strong manufacturing data. The odds of a June cut from the Federal Reserve dipping below 50%. And UK housing prices falling last month for the first time in the quarter, really, suggesting the market may be stagnating due to high mortgage rates and strained affordability. Plus, in commodities, oil rising as Tehran says Israel killed one of its top generals in a strike on Iran's embassy compound in Syria. A lot to digest there. Let's get a quick check on how these markets are faring, at least the equity markets across the continent. Green on the screen broadly, some outperformance right here in the UK with the FTSE 100. A lot of that really being driven by the yield story. Banking seems to be the sector that is outperforming. There's a lot to digest there because some of the other outperformers are going to be the commodity names. We just talked about the oil story, the gold story, all of that pushing some of the miners higher as well. So that is going to be crucial as well. In the meantime, we are getting some breaking inflation data. It has been a morning of inflation data across the continent of Europe. You've seen some really strong manufacturing numbers. Now you're getting them out of Germany as well. It looks like the Bavaria March CPI rising about 2.3% year over year. You've also got the Saxony March consumer prices 2.5% year over year, on a monthly basis higher by about 0.4%. Now remember, a lot of this, when you talk about the market reaction, has also been pricing in the data we got out of France, Spain, Italy, and of course the ISM numbers we got over in the US as well in yesterday's session. So net, what does that mean for the euro? Well, right now you are looking at some euro weakness on the table. It marginally gone to positive territory against the dollar, now paring back some of those gains, 107.35 on that currency pair. The theme here seems to be Europe is kind of chugging along, for lack of a better term. I'm curious how a true expert interprets this. Let's bring in our guest this morning, Aberdeen senior research economist Sri Kochu Govindan. I hope I said that name right. I apologize if I didn't. These numbers are largely manufacturing across Europe seems to be stronger than expected. Germany seems to be the continuous weak spot. How much of a positive or negative is that? What's your interpretation?
I think there are some positive signs in there, as you say. But overall, what we've seen so far in the euro area is that it's very narrowly missed a technical recession. Now, going forward, I think there are likely to be some sort of tailwinds in the second, which will start to materialize in the second half of the year. More meaningfully, where we start to see the impact of the rate hikes have largely that's behind us, and then as we've had indicated so far, particularly in the ECB Watchers Survey, Watchers Conference recently, that there's likely to be rate cuts beginning in June. I know that's a big debate over the weekend.
Yeah.
But as that feeds through, we're likely to see some stabilization in the euro area economy. Manufacturing data still got a 4 handle there with the PMIs, still in the 40s. So it's not ideal, but we do expect to see that sort of stabilizing and recovering going into the second half of the year.
You mentioned a little bit about the Fed pricing changes over the weekend. It has been volatile when Europe has been enjoying their long weekend. Yes. We're now seeing those cuts getting pushed back further and further, which begs the question, do you see that divergence between the U.S. and Europe accentuated? And is that even a problem?
I think that obviously there are risks. I mean, we still have penciled in a June as a start of the rate cut for a number of central banks, including the Fed, euro area as well. But obviously what we've seen over the weekend has really been the data. All of these central banks are data dependent. It will be very heavily reliant on what happens to inflation, and in particular core inflation. So core inflation we are expected to be relatively sticky and stable, but the key areas there would be the services sector. So what does this mean? I guess there are risks that we could see a delay in the US. But I think for the euro area, they would really need to be focused on their economy, looking at how, inflation trends are decelerating. They are on the correct path at the moment. And we do expect inflation to sort of dip below 2% later on in the year. So there are some good signs there. Even for the Fed, there are some good signs from the core PCE. But obviously, it's the breakdown where we're starting to see, the core inflation, if you annualize that, smooth it over 3 months, it's still not quite going in the right direction.
Yeah.
So possibly some delays, not derailed, but delays. Obviously, there are some upside risks that we're seeing coming through in the headlines.
There absolutely are. Hold that thought, because we are getting Germany numbers as well. More regions of Germany. Germany's North Rhine-Westphalia, I hope I'm saying that right as well. Their March CPI numbers rising about 2.3% on a year-over-year basis. We're still waiting for the monthly numbers and the breakdown there. But net, what you are seeing is that deceleration theme that you were just talking about. You're seeing it on both sides of the Atlantic. As we get that breakdown, we'll bring it right here. I want to come back to the manufacturing story, though, because we're talking more about that core inflation story kind of stagnating, driven by the services data, as you point out. What do you make of this manufacturing data that's come about? And even just in the last hour or so, we're seeing strength in French, Spanish, Italian manufacturing data, not necessarily Germany, but that's its own kind of story. Yeah. In line, just less than 24 hours after we got that ISM data out of the States. Is manufacturing relevant again for the U.S.?
I think within context, it's still a smaller part of the economy, but it is very important in terms of a signal of the overall trade picture. And we've had a lot of focus on what's happening with new orders, production picking up in the US.
Yeah.
And this is important from global spillovers as well. So yes, these are good signs that we've avoided a recession, that there is some stabilization. So yes, even though it's just less than 20% in some of the economy, in some economies, it's still relevant in terms of the direction of travel and the fact that we have narrowly missed a recession in a number of countries, including Japan as well. We've had that revision in data which shows that whereas it was a technical recession, moving into a marginally positive. So even though it's sluggish growth, it's still avoiding recession and therefore a positive story.
If it's a positive story, let's talk about the positive or not so positive story in Europe as well. Bringing it back to that theme of divergence here. In Europe, when we're talking about this weakness in Germany in particular, what does contagion look like to the rest of the continent, especially when we're seeing French, the services numbers kind of staying fairly strong relative to its German peers. You're seeing outperformance in Spain and Italy. Guy Johnson and I were just talking about this on the last show as well. Is that an impact of kind of fiscal stimulus that you're seeing Italy, for example, pumping money into their economy in a similar way that the United States is as well? The UK kind of doing its own thing with its housing story, so I don't want to loop that into the ECB. We do see a lot of these European continents traditionally perform together, except right now the narrative seems to be quite different per European country. The Germany story is the outlier here. When does that seep into the rest?
I think there are some idiosyncratic factors there for Germany, and these are some structural headwinds as well. Unfortunately, the nature of the economy has changed. The dynamics have changed in the sense of cheap energy, which had been a benefit for many years. That's now behind them. They were very, very reliant, obviously, on Russian energy. So there are some structural headwinds there, which they are working around. It is difficult for the rest of Europe to remain immune. You are correct there. But this is part of the decision-making process for the ECB. It's not just an inflation story there. They will be monitoring this activity data in Germany. And again, as we start to see the cuts coming through in the second half of this year, that will be a benefit for all of the economies. And furthermore, as you mentioned, there has been that fiscal tailwind so far. Unfortunately, that will start to fade for a number of countries across Europe as well as in the US. That was a tailwind that is starting to fade as well. So it's a bit of a net. It's still sort of sluggish growth that we're expecting across.
So what does the ECB pay attention to when it comes to Germany? We're talking about this contagion or lack thereof, as you point out. You kind of laid out the scenarios there. Should the ECB be more sensitive to the German story because of that read-through, given that Germany is still the largest economy in Europe? Or does it kind of ignore Germany for a little bit and pay attention to the strength everywhere else? Either way, it feels like a lose-lose for the ECB.
It is difficult. Obviously, they would say we consider all of the economies within our assessment, and they wouldn't sort of single out any particular country when they're discussing their views. But at the moment, they are very much focused on the services side of the story. So I know we had manufacturing data out earlier, but it is still that services inflation and what's happening with wage growth, real incomes, and these factors are starting to improve. And again, as we move into the second half of the year, we should see real incomes improving and some increase in spending, which we haven't really seen in the last few months, and that should start to feed through. And I think those are the factors they'll be looking at. But yes, Germany is a key economy that does have spillovers, so it's difficult to ignore what's happening there.
Stuck between a rock and a hard place, it seems like. So much to digest. We look forward to having you back on. Thank you so much for joining us this morning. Aberdeen's senior research economist Sri Kochu Govindan joining us this morning. In the meantime, we were talking about the outperformance in some of the European economies. Let's talk about outperformance in the UK stock market at the moment. The FTSE 100 headed for a record high close, up by 0.8%. Look, a lot of this is driven by two main sectors. The banking story, you're already seeing that massive move in gilts pushing the banking sector higher. You're also seeing a move in commodities this morning, also pushing some of the miners and some of the big oil higher as well. Shell, BP, alongside the likes of HSBC, Standard Chartered, Barclays, Lloyds. Those are your outperformers this morning, not to mention ASML is higher as well. That listing higher by, I think, 2.4% the last time I checked. All of that putting, again, the UK index to a record high. How much of it is it a catch-up trade? How much of it is driven by the fundamentals? We're going to stick with that story and monitor it for you. In the meantime, coming up on the program, we go from the stock market to the oil market, nearing a 5-month high. Oil trading higher. A lot of that on that Middle East risk and tightened supply. We're going to dive into that story next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The conversations that matter and the insights you need. Welcome back to The Pulse. I'm Kriti Gupta in London. Iran and Syria say an Israeli airstrike on Tehran's embassy in Damascus has killed several people, including 2 military generals. Iran's foreign minister says Israel should be held accountable for the repercussions of the attack as tensions grow between the longtime adversaries. Let's get a little bit more context here. Joining us now for more is Bloomberg's Dana Kreisch, joining us from Dubai, I believe. Dana, a pleasure to have you on the program. Walk us through the story. What do we know so far?
Yes, well, we know a suspected Israeli airstrike hit a compound linked to Iran's embassy in Damascus, killing at least 7 Iranians, including a high-ranking commander and his deputy. Images out of Syria show the building completely demolished as a result of this airstrike. Now, Iran did vow revenge, but Israel doesn't really comment on such attacks and has never done that. But it has said before and repeatedly that it would stop or obstruct weapons transfers via Syria or attack any Iran-linked assets to whatever it thinks is a threat to its existence.
Speaking of that threat to its existence, this has been a narrative that's been going on for a while here. How much of what we've heard in the last 24, 48 hours is actually an escalation?
This attack is quite an escalation, and Israel with it has upped the ante of its airstrikes in Syria. So since the October 7 attack against Israel, the northern front by Hamas, we have seen repeated attacks by Israel on Syria, attacking Iran-linked assets, including those linked to Hezbollah. And with this one, it's a more direct attack. This is a compound linked to Iran's embassy. It's more direct. It's more of Iran's official representation in Syria. And so it remains to be seen how Iran would retaliate against that. And it has repeatedly now, since last night, vowed retaliation. The Iranian foreign minister also said that he sent a message to the U.S. about this attack and kind of holding the U.S. responsible for it as well.
Well, speaking of that retaliation story, what does that even look like?
So earlier this year, we saw Iran attack Erbil, saying that there was kind of a spy headquarters linked to the Mossad, and it struck Baghdad as well and Iraq. Now, it can do that, but I think that Iran would probably retaliate and attack in a way that it won't hit a very harsh nerve here. We can see this probably via the Houthis upping the ante in the Red Sea, or Hezbollah maybe escalating attacks on Israel's northern border. But it probably will be calibrated, as Iran has repeatedly said it does not want or intends to be involved in a wider Middle East war.
All right, Bloomberg's Dana Kreisch monitoring those developments for us out of the Middle East. We thank you so much. Let's talk a little bit about how the geopolitics translates to the markets there. Oil holding near a 5-month high with high geopolitical risks and those supply constraints both creating a little bit of a tailwind to prices. I want to get a little bit more context here. Bloomberg's Anthony DiPaolo joins us this morning. Anthony, we've seen the oil market, and I would argue broader risk assets, kind of shrug off some of the geopolitics, especially some of the tensions coming out of the Middle East. How much of today's move higher is driven by the news that Dana was just walking us through?
Yeah, we did see a little bit additional jump in the oil price due to that, so it did give it a little bit of juice. We do have some risk premium in the price because of everything that's going on in the region, but oil perhaps hasn't reacted as strongly as one might think to a lot of the attacks on shipping in the region and generally the state of war in the region. As far as those shipping attacks go, we haven't really seen oil supplies affected per se. It's taking longer. Insurance, shipping rates are up a little bit, so that's coming through in a little bit of the general cost to the market. But we haven't seen those supplies impacted yet, and so that's the real issue why oil hasn't been reacting as strongly. But we did see some strength in oil in the first quarter, and it's keeping those gains now a little bit stronger after this attack in the Middle East now. But we are continuing to see that, and that's partly because of those OPEC plus cuts that are affecting exactly that supply in terms of the market. So we're tightening a little bit, and OPEC is expected to, at a meeting this week of a technical committee, not to make any recommendations for change. So we're probably going to see that through the rest of this quarter, Kriti.
It's interesting that you mentioned OPEC Plus. We will have a lot of headlines coming out of Mexico as well in terms of their supply. You have headlines coming out of the United States hitting those record oil exports, kind of trying to seep in to those other markets around the world. Is OPEC Plus concerned about that at any point? Is there something that's going to kind of seep in when we talk about that excess supply?
Well, one of the challenges that OPEC Plus is dealing with, and one of the reasons why they are reducing production, is because of all that non-OPEC supply that's coming on. So the U.S. is bringing on supply this year. There are new supplies coming on from Brazil, from Guyana. And so those additional barrels in the market are going to take up a lot of the extra demand increase that we expect to see this year. So that's that challenge for OPEC. Where do they find the space for their oil to come back into the market? And so that's what they're dealing with. That's why they're taking those barrels off the market now so that they stop inventories from building. And they want to see that market tighten before they begin putting those barrels back. So right now, a lot of the analysts looking at the market are expecting that the market will be tightened by the end of the year, and so that's kind of the framework, the time frame when OPEC could come back into the market with those additional barrels.
All right, Bloomberg's Anthony DiPaolo joining us from Dubai, walking us through some of the dynamics in the oil market at the moment. Coming up, we go from the commodity story to the broader macro story right here in the UK. We'll be discussing UK house prices nationwide reporting their first dip in the data for the first time this quarter. More on that next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
South Africa's main opposition leader says he would resist forming a coalition with the ruling ANC, speaking exclusively with Bloomberg.
We have already got a pre-prepared agreement about how we're going to work together, how we're going to stabilize a coalition, and how we're going to make sure it governs effectively.
Why not just have one single party ruling the country? I mean, is it because of the past 30 years of the ANC? What is it that you're so opposed to?
I think that if you look in South Africa, people are very brand loyal to organizations and brands. It would be, I think, foolhardy a year before an election to form a totally new party and expect it to get the name recognition and the traction.
I mean, we're seeing a lot of new parties.
We are seeing a lot of new parties, and we're seeing the fact that they're not making the breakthroughs that people would expect them to, precisely because they're unknown quantities. We're hoping that the multi-party charter, the whole, is going to end up being greater than the sum of the parts. The IFP can go on the hunt for votes in rural KwaZulu-Natal. The Freedom Front can bring votes in from rural parts of the Northwest and those communities. The ACDP can bring in the religious voters. And to bring all of those to the table to form a big pile of chips that can be used to be able to form a government.
What about the DA and the ANC?
No, we don't want to be in government with the ANC, and that's precisely...
So that is out of the question.
No, it's precisely why we formed the multi-party charter. My job is to get the ANC out of government. I don't think we're going to solve the country's problems by having the same people who are responsible for the economic crisis, the social crisis, and the infrastructure crisis sitting around the table. We've got to change them, and that's why the multi-party charter has said we will not do deals with the ANC or the EFF.
What if we see a scenario where the ANC still is somewhat in the majority? Is the DA going to rule out working?
We will go back to the multi-party charter, and we will decide on what the best option for it. It may be a minority. Maybe we could form a minority government as a multi-party charter. I just think there's too many unknowns at this stage to say my focus is on getting the ANC way below 50% and getting a new set of people around the table so we can get our country off this low growth, high debt, high unemployment trajectory.
Names in tech are on Bloomberg.
There's a natural tension
between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Morning and welcome to The Pulse. I'm Kriti Gupta in London. We talked a little bit about the European inflation story. There's also an inflation story right here in the UK, starting with housing. UK house prices falling, however, in March for the first time in 3 months. This data coming from Nationwide Building Society suggesting the market may be stagnating due to high mortgage rates. We're expected to get that data in just a few seconds amid some of that strained affordability story. Let's get more on the story with Bloomberg's European economist Neeraj Shah. Neeraj, talk to us about the data that we got first to begin with. This dip in housing prices feels more like a stagnation story than a proper deceleration.
So it highlights how the recovery is going to be bumpy ahead, really. So you had actually quite robust growth at the start of the year, the first 2 months of the year, and then you've had this slight dip. But overall, we've turned the corner, and ahead it's going to be more bumpy, and this really highlights that.
Well, speaking of bumpy, we're actually just getting that mortgage approval data as we speak. That February number's coming in about 60,383, a very specific number, but significantly higher than about 56.5 that was expected. Double-folded question here. One, does that data signify anything in terms of the fact that we're coupling it with that dip in the nationwide prices? What are you waiting for the data to be more promising?
Well, that actually already is quite promising, 60,000, and that's quite a significant jump. And it's only about 6,000 below the long-term average. So that suggests that people are going back into the market, applying for mortgages, and there's always a lag. So this is going to be 3 months ahead.
Yeah.
You're going to see a slight more pickup. So that's actually quite encouraging. But again, a lot depends on the Bank of England and when they cut rates. We've already saw at the start of the year, rates were dipping, mortgage rates, and they've crept up a little bit because expectations have tempered. But essentially, we're expecting rate cuts from June, and rates to end at 4% this year and 3% next year. That would get the housing market going.
So resiliency seems to be a little bit of the theme here, starting to kind of come back in. It hasn't crashed yet. You've made the argument in the past that there was an expectation that maybe it should have a year ago. Why didn't that happen?
So it's a great question. So really, you saw this incredible rise in interest rates, but the big thing was people kept their jobs. Unemployment still remained near record lows, And also, a lot of people were on fixed mortgages, so they had time to adjust. So you didn't have the forced sales that would flood the market, and that was a big reason why prices didn't crash. But you did have a correction. So the nationwide house prices are still 4.5% below their peak in 2022. And in real terms, when you take into account of inflation, they're down about 15%. So there's been a correction rather than a crash.
I love that. Correction rather than a crash. Is that music to the Bank of England's ears, or is that they're still more concerned? Is there still more of a kind of sensitivity around some of the data?
I think that is music to the Bank of England's ear, and it's something that reassures a lot of people. We want a kind of Goldilocks recovery, and there's still some concerns over wage growth and whether inflation won't actually fall or come back up a little later on. So, but overall, it's encouraging.
A final question on just kind of where the extra supply may or may not come from. There's some big promises on the fiscal side about, at least in terms of the Labour government, what the extra supply in the market may actually look like. Does that make a difference to this data at all?
So that's more long term. But one thing that does make a difference is we just had last week Yorkshire Building Society offering mortgages with a 1% deposit. So that might help some of those first-time buyers really struggling to get a deposit together. You've just had other data showing rents have gone up to a record above £2,000 for the first time in London.
Yeah.
So they're scrambling to get a deposit together. So this just might help them.
The affordability story at its core, and one that really is a global one. We thank you so much for bringing us a little bit more insight. Bloomberg's European economist Neeraj Shah talking to us about the UK housing story and where it may or may not be going wrong, and sticking with some of the data that we got. We got it from the UK. We also got some US data in the last 24, 48 hours where you've seen some really big sensitivity, strong factory data in particular, prompting traders to price in less easing from the Federal Reserve this year, setting the odds of a first move in June below 50%. That all squared with some caution from Jay Powell on Friday.
The report that came out this morning is pretty much in line with our expectations. We're making progress. This is good, but we need to see more. The decision to begin to reduce rates is a very, very important one. The economy is strong. We see very strong growth. We had growth for last year over 3%. We don't need to be in a hurry to cut. It means we can wait and become more confident. I don't think rates will go back down to the very, very low levels they were at before the pandemic. This economy doesn't feel like it's suffering.
Let's bring in Bloomberg's Ven Rom from our Markets Live team. Ven, this sensitivity to the ISM data, we usually don't see a sustained move like we do, or like we did in the last 24 hours. An 10 to 14 basis point move based on where you look at the curve. It traditionally tends to be a knee-jerk reaction that then kind of comes back. Why the sensitivity to American manufacturing now?
Morning, Kriti. The sensitivity owes in large part not so much to the ISM headline number, but the prices paid number. If you look at that gauge, prices are back up to the highest since July 2022. That is, of course, when the Fed had just started raising rates. So basically, if prices are going to go back to those levels, and the market's worst fears are being kindled, which is that, look, if the Fed's cumulative policy tightening of 500 basis points hasn't made much of a dent on price pressures, then what is to stop a reacceleration of inflation? That speaks to the market's worst fears, and which is why you got the kind of vehement reaction that you got in Treasuries last night.
We're talking about the read-through, though, for the rest of the world here. If we look at some of the manufacturing strength that you're seeing in the United States, well, it was matched in just the last hour to 2 hours in Italy, in Spain, in France as well. All those manufacturing numbers coming in hot this morning. What is the trade there? Is this an early sign that people need to start hedging inflation again?
Yeah, possibly. I mean, we should prepare for, I think, forget 2% inflation targets. I think we are more like in the cusp of 3% inflation that's going to bob around those levels for some time now. I don't think we are expecting a reacceleration of inflation back to those numbers that we saw, horrendous numbers that we saw in 2021 and 2022. But 3% feels like the new 2%, and the market should prepare for it.
How does the market prepare for it, though? There is one part of the market that is piling into gold. On the surface, it looks like an inflation hedge. It may or may not be, depending on where you actually see that demand coming from. What are the other ways to actually position for it?
Well, the best way to position for it is in terms of real rates. Real rates are going to go back higher. I mean, they're a lot stickier already. In this quarter, we have seen real yields back higher, and that will go higher, even higher from current levels. The dollar is going to be a lot stronger. So those are the two cleanest ways to position for this new inflation regime that we've got.
A really interesting dynamic. I'll save a last one for you. This is kind of the wild card that I got to say I can't really fold into the global inflationary story either. Let's talk about the lira, because record highs for gold, but also some very interesting levels for the lira as well. A lot of that driven by some municipal election results. This is a market that a lot of people have already pulled out of, not a ton of exposure here, but one that people I think like to watch is kind of almost from a spectator perspective. Your take on the Turkish lira?
Well, I think that the lira has fallen a lot over the past 5 years. It's kind of lost more than half its value, and this year alone it's fallen more than 8%. Look, the bulk of the currency adjustment to the macroeconomic fundamentals has already taken place. And I think the investors are going to wait and watch from here to see how inflation evolves. We are expecting the headline inflation numbers to come out again tomorrow. And if it's going to bob around current levels, I think the markets are going to be okay with it. If you look at the 1-month inter-deposit rate, which is a function of market expectations on where the Turkish 1-week benchmark rate is headed, I think that the markets are not thinking they need another massive hike like the 500 basis points that we got from the Turkish Central Bank last time. So I think that, the worst case fears are being laid to rest here. But, politics is something that we can't factor in. I mean, so that is going to be a big that's going to be a big canary in the coal mine, and investors have to watch for it, watch for any risks from there. But I think that the bulk of the currency adjustment has already taken place.
An interesting one to watch for sure. Bloomberg's Ben Ram, we thank you so much for your analysis this morning. We'll make a strong pivot here away from the markets to a very exciting guest we have coming up. We speak with the latest innovator featured in Bloomberg's Industry Shakers, Fonde Dumuya, founder of Labrum, joining us as we look at the future of British luxury design. Stick with us. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
the conversations that matter, and the insights you need. Welcome back to The Pulse. I'm Kriti Gupta in London. Industry Shakers is a Bloomberg special series profiling Black and diverse entrepreneurs and innovators across a range of sectors. My next guest is creative director of fashion brand Labrum, which combines West African heritage and values with classic British tailoring. His collections have featured a collaboration with Adidas and Guinness, and last year saw him presented with the Queen Elizabeth II Award for British Design. I'm pleased to say Fade Doumbouya joins me right here on set. Welcome to Bloomberg. It's a pleasure to have you on the program.
Thank you.
Look, we're a financial network first, so we got to start off with the business aspect of this. West African design meets British tailoring. Talk to us a little bit about the audience, the market that you're trying to target.
Well, thanks for having me in the first place. My audience is quite mixed. Like I said, we're telling West African stories together with British tailoring. So it's a global audience. It's the people that understands the stories and people that know why people move and people migrate from place to place and how that touches them. Their world. That's what we're trying to do. It's the messaging more about than the clothing. It's all about communities, about how we bring those people to life within those designs. That's what we're about. So if you ask me in terms of what's the reach, it's like global. So you could be anyone that could wear my clothes. So it could be Asia, Europe, Africa, America, everywhere, to be honest.
Who are you competing with? When you look at your peer group in the luxury space, who do you feel like is the market share that you want to get?
For me, in terms of market share, I'm kind of taking it from different people. For example, Oswald Boateng does really amazing suits and then mixing colors. So some of those are some of my market. You have my peers, people like Bianca Saunders. We tell stories a lot, and she tells stories about a Caribbean culture, and I tell stories about African and British tailoring. So those are the people that I see that kind of like fits in within my market, together with the likes of Nicholas Daly and people like Aliwalia as well. So and also when we talk about bigger brands and we talk about the likes of Burberry. And it's what they do, how they interpret prints in their storytelling.
I love that we're talking about kind of prints and the appetite for luxury right now, because you'll know better than anyone that we're coming in an environment where luxury, they're able to keep their kind of core wealthier audience and wealthier consumer demographic. But when it comes to that kind of mass market consumption, we're in an inflationary environment, we're talking about a recession, et cetera, there isn't as much appetite for luxury, even in the States, from kind of that mass market consumer. What changes that? How do you appeal to someone who says, I can't afford the bigger brands?
Yeah, again, like I said, the thing about Labrum, the thing about our garments and the design, it's more about the storytelling. I think we sell the story, people buy into the story, become a fan, and then we take them through the journey of how the garment is created, from design in London, development fabric in France and the UK. And I think once the consumer kind of understand that journey, and they tend to want to connect and buy the product, because the people that actually just look for cheaper product probably doesn't understand the story behind it. And if you understand the story and also the longevity of the garment, sometimes it kind of sway your purchasing power. So I think those are the people we appeal to, people that love stories, buy into the stories, connect with brands, and the things that make them feel like they're part of the journey. I think that's what we were trying to connect with. Because sometimes if you look at the mass market, it's very difficult to compete, because the likes of Primark doing garment for like £5.
Yeah.
We don't compete in that, because we know that's completely out of what we believe in. So what we're saying is pay people for what it's worth. So what we're developing is we work with artisans in Africa and all over the world, because we believe in what they've tried to create, and that's why the brand tells the stories, and that's why the price point is what it is, and the luxury where we sit in.
You use that word artisanal,
yeah,
which to me thinks of quality, quality fabrics, crafting, and classics and classic pieces. And when I think of classic pieces, I think of Adidas, for example, or Adidas, as I'm told is pronounced in this part of the world. You have a collaboration coming up with Adidas. Talk to us a little bit more about how you're collaborating with other more established brands.
Yeah, collaboration is a beautiful thing because you're tapping into other brands, like sort of network, their consumers. With Adidas, they believe in the story that I tell. They believe in my journey, so they've been supporting me for several years now. I think to them, collaboration is always like, how can they amplify an up-and-coming brand story? I think that's where they come in on this. I've worked with like several collaborations with them recently. I did a samba for my show, which was again inspired by the Normally, and which is a story back home where I'm from. And then also we're working with them designing the Sierra Leone Olympic kit, which hasn't been unveiled yet anywhere. So it's just a conversation we're having about that. It's been worked on, it's been designed. Hopefully we'll showcase that at the end of the month or maybe May. So again, they don't just collaborate, they bring their resources, they support you. I think that's the interesting thing about collaboration, because you tap into resources that you probably wouldn't have.
So you talked about the Adidas collaboration. Any others on your radar? What's on your wish list?
I have interesting stuff coming up, which unfortunately I can't talk about. Hopefully will be out.
To give us the exclusive when it comes out.
Yes, we'll try and make sure we do that. But yeah, my wish list, is to work with Adidas in an aspect that I wish I could say much about that, but yeah.
We'll come back. Talk to us a little bit about then of your expansion plans. You're already in Selfridges. You're already in Harrods. You mentioned the United States as a market that perhaps you want to expand to or have a bigger reach at. When you're talking about department stores and that mass consumption kind of story, you're already partnering with Adidas. To me, as an American, it comes Macy's, Bloomingdale's, Dillard's, Nordstrom. Any of those on your radar?
Yeah, Nordstrom specifically is on my radar, to be honest. And also, we did stock in H. Lorenzo in LA. And for us, I think it's not about huge, it's more about, can this store represent us? Can they tell the story that we tell? I think that's why we work with Selfridges and Browns in London, because they kind of embrace the story, showcase what we do, and then that's what we look for partnership in terms of like the stores that we go into. Yes, Nordstrom, we've been talking to them for a while now. But I think for me, selecting those stores is, can they represent us? Can they represent the story behind the garment? Yeah. And I think that's why we're going to select like a handful of some of the stores that we can go into, because we don't produce a lot. Yeah. So we produce like what consumer can consume, and we also do a lot of bespoke, because we develop all our fabrics ourselves. Is to give the consumer these options of like, come into one of our store. Hopefully we'll be opening a store in a couple of weeks, for consumers to come in and be able to kind of select those fabrics, and we can make something for them. I think that's that niche the brand has.
All right, very quickly, I'm going to put you on the spot. Any pushback that you're getting in terms of department stores, in terms of collaborations, any hurdles that you're finding, very quickly?
For now, I think the hurdles was like some of the stores, they probably think very, very huge and numbers. And then for us, it's more like we want it to be niche. We want it to be more about the storytelling and don't oversaturate the market. And I think that's some of the pushback, because some of the stores are so huge, they look at big volumes. And I think because of what we do and then the way we portray the product is probably doesn't work for them. But the stores that actually understands it, they always carry us. So.
Fade, a pleasure to have you on the program. I feel like I've learned so much in the last 10 minutes or so. We thank you so much for joining the program. Fade Doumbouya there, founder of Labron, joining us for a little bit more about his business and his story as well. Coming up on the program, Tesla's trading lower pre-market as analysts lower projections for the EV maker's latest deliveries report. Details ahead. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal. That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
We are expected to get Tesla's deliveries report today. Wall Street analysts lowering the projections over and over again, though. What gives? Let's bring in a true expert. Craig Trudell joins me right here on set. Craig, walk us through some of these numbers and why people are more and more pessimistic.
Yeah, we saw consensus really drop like a rock as the quarter was coming to a close. A lot of softness we're seeing in China toward the end of the quarter. Our colleagues in China reported that the Shanghai plant will move down to a sort of lower schedule of production. We're also seeing some weakness in the U.S. in terms of basically just, these are tired models after all. The Model 3 and Model Y have been out quite a while. This is a company that desperately needs to bring new product to market. The Cybertruck, of course, only just started sales late last year, but that's a low volume product. And looking like it's going to remain that for some time because of the challenges of manufacturing it. So this is a company that is just expected to have trouble until they bring that cheaper model to market, hopefully late next year.
And we've already seen the stock at least trade pre-market a little bit lower. Craig Trudell, Global Autos Editor, we thank you so much. This is Bloomberg.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always going to be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Cranny. Danny Berger is out this week. It is Bloomberg Booth. Let's set your agenda. June rate cuts reappraised to the toss of a coin as the U.S. manufacturing snaps back. UBS plans to buy back shares to the value of $2 billion beginning this year. And Tesla may be headed for a gloomy milestone as waning EV demand takes its toll on sales. A very good morning. Suddenly, the equity market is doing battle with an 11-bip rise in the bond market. So suddenly rate cuts do matter to the equity market. SPOOs are down by 1/10%. JP Morgan make the point that the equity market has so far been pretty much immune to what's going on in the rate markets. But we need to close that gap, and you need to close that gap in the form of earnings. Tesla at the bottom of your screen, we're waiting for those deliveries. BYD taking literally chunks and bites out of the Tesla treasure trove of demand in China. So stocks are that little bit lower. You're going to get a raft of Fed speak. By the way, in Europe, you can see the energy component. Oil is at a 5-month high. The likes of Total and Eni are both bid up this morning. So the energy component is at a 5-month high. You're seeing a nice bid tone there. Roll it over, have a look at the bond market. As I say, there was a little bit of a Damascene moment for the bond market yesterday. Prices paid in the ISM data. That's in the belly of the data is really what irked this market. Good news for the economy is bad news for the rates market. As you can see, 10-year yields at the moment, they're steadying their nerves. Spiked by 11 basis points yesterday. You saw this curve steepening go through. Oil is up as we see this tension between the strikes from Israel on Iranian assets inside Syria. What is the next step of retaliation potentially from the Iranians? That is what the market is debating there. And as we go slightly risk off in equities, bid up in bonds, and the rate cut narrative shifts, so Bitcoin gives ever such a little bit back. Now, as we've been saying to you, strong ISM data sinks in. The odds of that rate cut for June slip to below 50%. Our next guest writes this. It is Bano Baveja, and this is what he says. We agree that inflation will continue to moderate over the coming year. We're much less certain about the growth outlook, given the recent rise in the short-dated break-evens. The market's concern seems to be the opposite. Bano joins us now. He is the chief strategist at UBS. So Bano, good to have you with me. You talk about the market's left tail risk is an inflation resurgence, not a growth drop. But you have your doubts about growth dropping. You think a little bit more risk of a growth drop rather than the second coming of inflation. Why?
When you look at inflation, Manas, most of the inflation data that had been very strong for a long period of time, energy, food, supply bottleneck-driven inflation in goods, that has begun to come off in a very material fashion. And the remaining inflation, as the Fed chair likes to focus on, which is sort of core services ex-housing, that hasn't come off as yet, but we are seeing signs of a slow and steady weakening in the labor market, or as Fed speakers like to say, the labor market coming into a greater balance, the supply of labor increasing, the demand of labor coming down. And that should mean that over time, because you are going to get a payrolls report this week, which I think is going to be quite strong, both in terms of the headline number and also in terms of the average wages, we do think that over time these wages will begin to come off. The quits rate is telling us that. And as the labor market weakens modestly over the coming quarters, that should mean that inflation comes off. So we are with the Fed on inflation. We do think that the recent increases in inflation, including in core PCE, 6-month core PCE annualized, heading up towards about 2.9%, we do think that there's a little bit of noise out there, and we do think that in the coming months, inflation should, along with the labor market, weaken. Where we are more worried is that the market seems to have, and I say the market, the equity market, and also bond pricing, as you were talking about, seems to have this implicit faith that the kind of growth we have seen in Q3, Q4, and some of the early numbers in Q1 have also been quite strong. They're extrapolating that into the course of 2024 and 2025. And we think that's been extraordinarily strong growth, both from the consumer and also from the government. So the government sector has also contributed, including in investment. We don't think that will sustain. We think real disposable income growth is likely to come off. So we are looking for weaker growth. So for me, the left tail risk is much more on growth. And given what the market is pricing right now, right, in terms of rate cuts, we're actually we're in the camp that we think that receiving the very front end in the U.S. actually does make sense here. You know, we don't see the 2-year getting much above 480.
Banu, that's probably the most you've been perhaps the most bearish guest that I've had, and hanging your hat on data. In other words, you are concerned about a slowdown, you're concerned about the quits rate, and as you say, that left tail risk for you is more about growth. What does that do then in terms of, I mean, we asphyxiated yesterday for a moment in the bond market, an 11 basis point rise. There was a slight hysterical reaction. Given the roadmap that you've got, are you then pricing in higher or more rate cuts going into 2025 than perhaps the market is at the moment? And what is the consequence of that for asset allocation?
Yes. So the answer to those questions is yes, we are a little more concerned about the U.S. growth outlook than the consensus is. We are a little more concerned about earnings growth globally than the consensus is. So we are on the bearish side of consensus over the coming 2 years. Now, in terms of rate cuts, the market has now begun to price in less than 3 rate cuts for this year. We are looking for 3 rate cuts through the course of 2024, but where we are really different from consensus, where the market is, again, looking for about 3 cuts in 2025, we're looking for 5 cuts in 2025. So we would probably be small received in December 24, so 1-year money, but we would actually be bigger receivers in 1-year money. So net, that basically means that 2-year at about 470, give or take, we find that quite attractive. I'm not saying that this is topped to the second decimal point. There is a possibility of an increase, again, especially as this week we're going to see non-farm payrolls data, which we think is going to be near-term quite strong. That can lead to the 2-year rising further. That can lead to further rate cuts being priced out, sort of the Bostic view. But that will probably mean that 480 is sort of a top on the 2-year, whereas the risk on the other side, if we are right about growth concerns in Q2 onwards, Q4 of this year, could mean that we see the 2-year coming down by about 70 basis points.
So going forward with risk assets then into equities, I understand owning the very, very short end, you pick up 4.7, as you say, it is attractive. But if you're penciling in 5 rate cuts, that's on lower growth. That is not a pro-equity narrative, is it?
No, it isn't, man. So in asset allocation terms, we are very much bonds over equities across all regions, but particularly so in the U.S. We do think in the near term, the earnings picture for the U.S. market looks reasonably strong. And then, ironically, through the rest of the year, we are actually going to see tech earnings momentum come a little bit lower and it broaden out to the remaining parts of the market. So the market should remain reasonably steady, but at a time when bonds are rallying, bonds should outperform equities over the next 12 months. And we feel that that is the case for the U.S. We do think that's the case for Europe. China is a completely different conversation, so I don't think we can throw in China or Asia more broadly into that conversation. I think China, Japan, these are places where we certainly prefer equities over bonds.
I'd like to be at dinner with you and Mark Hafley then in terms of asset allocation to equities over the next 12 months. You mentioned China. It is one of our most read stories this morning, the re-energizing a story from Xi Jinping in the latter part of last year, where he talked about the bond markets and perhaps being more active in those bond markets. I haven't got the verbatim in front of me. Do you see a risk of QE in China as the story pretends?
We don't. So we don't think that the PBOC is going to be made to come into the market and come into the primary bond market and buy bonds as actively. I think they will be active in the secondary bond market and increasing their footprint out there. But we do think that the liquidity support, even if it's not through direct QE, we do think the liquidity support through MLF is likely to continue. I think the number to really focus on is the credit impulse and, more importantly, perhaps the fiscal impulse. Both of these have been pretty mediocre so far at a time when the housing market has not completely stabilized. So we do think that as the U.S. economy comes off the boil, as the Federal Reserve begins to be a little more dovish, and the pressure on dollar renminbi, the upwards pressure on dollar renminbi eases, I think the possibility of China giving us more stimulus, both in fiscal terms and in monetary terms, is high. And ahead of that, we don't want to be very negative on Chinese equity. So this is a tactical call. This is not a 5-year call, but more a 6 to 12-month call. But this is a time when we think, unlike the U.S., where we have a strong preference for bonds over equities, in China we'd much rather be in equities, particularly in certain selective sectors like the internet sector.
Okay, brave call. Let's see what happens. Mind you, it is a growing course that is joining you on that call. Banu, great to have you with me this morning. Banu Baveja of UBS. Other stories trending on the Bloomberg terminal this Tuesday morning. Rubrik, a cloud and data security startup backed by Microsoft, has filed for an IPO disclosing growing revenue and losses. The size and the price of Rubrik's planned share is disclosed in a later filing. The filing follows trading debuts by Reddit and Astera Labs. The Wall Street Journal reports that Disney is leading its proxy fight against the billionaire Nelson Peltz, with more than half the votes counted. BlackRock and T. Rowe Price are among the supporters. Donald Trump paid a $175 million bond that will put a massive civil fraud verdict on hold while he appeals. Separately, the former president's net worth dropped by $1 billion. This after the shares of his media company tumbled following the disclosure of a $58 million loss for 2023. And Elon Musk is now officially Austin's largest private employer. Tesla boosted its headcount in the region by 86% last year. Meanwhile, some of Wall Street are braced for Tesla's first sales decline since the early days of the pandemic. We'll hear more on that later this hour. And as Banu was just saying, they prefer bonds to equities in the US. We have got a reaction function in the European and the UK bond markets on the back of that pretty significant move in 10-year government bond yields yesterday. Bunds up by 5 basis points and the UK up by nearly 10 basis points. Coming up, we are building tension in the Middle East after a deadly strike on Iran's consulate in Syria. The consequences and the response expected. Coming up on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York. Now, Iran is summoning the U.S. in response to what they call Israel's crime of striking Iran's consulate in Syria. The Islamic Republic says that it sent the U.S., quote, an important message over the airstrike that they claim killed at least 7 people, including senior military commanders. Heightened tensions in the region are sending Brent crude to a 5-month high. Let's bring in Dana Kresh, who has covering this story. What do we know so far? Because this actually is pretty high-ranking Iranian forces have been killed. But the details, Dana, good day.
Hi. Iran says that Israel is behind an airstrike on a compound linked to its embassy in Damascus, that's in the heart of the Syrian capital, killing at least 7 Iranians, including a high-ranking commander and his deputy. Images out of Syria show that the building is completely demolished as a result of this airstrike. We saw Syrian media also saying that Israel was behind this attack. While Israel doesn't really and rarely comments on such attacks, whether in Syria or elsewhere, that it is accused of conducting, Israel has repeatedly said that it would obstruct any weapons transfer to Iran-linked militias via Syria, or anything that would actually be a threat to its existence. And we see Iran today vowing to retaliate and saying that this would not go unanswered. As to who this person is, among them is a high-ranking commander who was in the Quds force in Lebanon and Syria, and that means he perhaps is involved in foreign operations by the Iran Revolutionary Guard Corps. And we saw Hezbollah calling him a loyal friend and someone who's worked to improve the work of the quote-unquote resistance group in Lebanon for years.
So, Dana, with this in mind, we listen to the Iranian language quite quickly. They talk about a decisive response. Do we understand what level of escalation that may well mean? I mean, if you look at escalation, given that Israel has struck Syria over the years, but this is a strike with a difference. So what escalation level is expected?
So this strike is a direct hit on an Iran consulate, on an Iran embassy. So this is much different than previous attacks that Israel had conducted since October 7, and this year as well. This year, it really upped the ante. throughout the past several months, and especially now with this strike. How Iran would retaliate, of course, remains to be seen. It could take a more calibrated response to not hit a nerve in the region, and it is the one that's been saying we don't want to get involved in a wider war in the Middle East. Earlier this year, Iran did hit Erbil, saying that they were attacking a HQ, a spy HQ for the Mossad. That really kind of escalated tensions between Baghdad and Tehran, but it was still calibrated and it was still within, I would say, rules of engagement.
Okay, Dana, thank you so much. Let's see the line coming through from the Iranian Prime Minister, Ibrahim Raisi. The crime won't remain unanswered. Oil is trading at a 5-month high. The markets are in trying to calibrate what happens next. You've got a number of other facets going on with the oil market as well, not just the Israeli airstrike on the Iranian embassy in Syria, but also Mexico cutting its exports over the next few months, according to Pemex. The position in the market, net longs are at a 13-month high, and Brent crude trades at $88.72. So we have OPEC plus barrels off the market, and we also have this heightened geopolitical tension. This, of course, will all play into monetary policy and the risks of a second spike in inflation. More to come on Bloomberg. Good morning from New York.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lyons deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Menace Cranny in New York. The yen is paring back some of its weakness against the dollar, driven by strong U.S. data. Still, the risk that Japan's currency will see intervention, it's rising at these levels. Let's take a listen to what Mark Mobius, the co-founder, had to say.
the Japanese are fighting a losing battle, and they might as well give up. There's no way that you're going to do anything to strengthen the yen, and it'll probably continue to weaken. At the end of the day, it's probably good news for some people, because if you're shorting the yen, you're doing fine. But the other interesting thing about the yen and about Japan in general is that a lot of the Japanese investment money is finding its way into Southeast Asia and to emerging markets generally. And I think that's a very interesting development, because they realize now that they have to make their mark, like China has been doing in these countries. And so the yen will be distributed widely in these emerging market countries.
Mark Mobius, we talk about how the yen, the weak yen, is supporting the stocks. We're looking at a 50% upside in the last 12 months for Japanese stocks. I mean, how much more upside can be expected? I mean, the likes of Larry Fink says, as long as the yen remains at about 150, we can expect Japanese stocks to continue to go upwards.
The trend is your friend. It will continue to move up, not because of the yen necessarily, but because of what's happening with Japanese industry and what's happening in the chip market. You know, the chip revolution globally is becoming more and more intense, with more sophisticated chips being produced, and Japan is at the forefront of this development. So that is going to help them a lot. And you notice that in Korea, chip exports are really leading the export revolution that's taking place there.
Mark, as you say, Japan stocks, the trend is your friend. There's structural reform happening. Yes, they've come a long way over the last couple of years, but it's not like they're long-term expensive yet. It still seems like good investment, but they're probably unlikely to continue leading the kind of gains in Asia. Or do you think they can continue leading the gains? If you think it's somewhere else in Asia that can start kind of taking the forefront of gains, where is your pick of the other Asian equity markets?
The pick for me is India. India is the place, even though India has come back a lot, and it has even at some point outperformed the US market, India has still got a long way to go. And by the way, Japan is going to play a role in India. As you know, relations between Japan and China have not been the best. China's been a big market for Japan, but they realize that this cannot continue, and they're beginning to make a big push into India, and that's going to boost not only Indian stocks, but also it's going to help the Japanese stocks as well, those who are going into India.
That was the Mobius co-founder, Mark Mobius, speaking to the team a little bit earlier about yen and the possibility of intervention, perhaps fighting a losing battle. Just checking in. I mean, there was a skirmish in dollar yen up to 158, 150, I should say, a little bit earlier. Now, we're off that, but here's the thing. The finance minister last week, Suzuki, made it very, very clear that they were willing to take bold measures on excessive moves. What are bold measures? Back in 2022, September and October 2022, the Japanese authorities spent $59 billion. Well, what's it going to take to deliver a 5 big-figure move? Nomura says it's going to take a significant several trillion yen to re-grasp the narrative on the yen. The dollar this morning, as you can see, is flat after a little bit of a pop yesterday on higher short yields. Roll it over and have a look at the consequence in the bond market. You've got the European, this is the 10-year government bond yields over the past 2 days, up 12 basis points. We've just had Banu Baveja from UBS talking about 5 rate cuts going into 2025. He is more concerned about the growth narrative than he is about inflation. Roll it over, have a look, because this is where we are pricing at the moment. Steepeners are the name of the game in the US. Germany playing the catch-up game, up 7 basis points, and the UK pops higher. Again, all repricing to the US narrative. Coming up, Moritz Kramer of LBBW joins me to talk about deficits and the risks to the world.
cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the celebrity beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead, the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
so
destinations.
Functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to do?
How about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, to having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Brief. I'm Menace Cranny in New York. Danny Berger is out for a well-deserved week break. Here's what you need to know. June rate cuts reappraised to the toss of a coin as the U.S. manufacturing snaps back. UBS plans to buy back shares worth as much as $2 billion beginning this year. And Tesla may be headed for a gloomy milestone as waning EV demand takes its toll on sales. A very good morning. Suddenly, stocks are a little bit more harried by the prospect of higher rates. You're just showing a dip into the red for the S&P 500. Tesla at the bottom of your screen. We're counting down to the quarterly sales numbers there. We expect 449,080 vehicles, down by 7%. The stock is down 1.38% this morning. There's a gap. There's a gap between the expectations of what the Fed will do and stocks. We've just had Banu Baveja of UBS. He is scathing on the growth side, not so much on the inflation side, and sees 5 rate cuts going into 2024. Do you want to be long stocks on 5 rate cuts if growth is under pressure? Stocks in Europe are bid this morning. Oil at a 5-month high. We have the Israeli airstrike on an Iranian embassy in Syria taking oil higher this morning. The energy component, as you can see, is the alpha in Europe this morning, up 2.61%. On the bond market, as I said, we have had this spike in 10-year government bond yields, and that is just leveling out this morning at 432. But you did pop by over 10 basis points yesterday. The odds of a June rate cut have been shredded to less than 50%. There is a complacency in bond markets according to JP Morgan, and you've got crude, as I say, up 1.8% on the heightened tensions in the Middle East, and Bitcoin gives a little bit back as we reappraise risk. So you're down on Bitcoin at the moment, you're down 5.1%. That's down 10% from its peak in March. So talking about debt and deficits, the Citadel founder Ken Griffin is warning investors about the growing national debt. He wrote this in a letter. It is irresponsible for the U.S. government to incur a deficit of 6.4% when unemployment is hovering around 3.75%. We must stop borrowing at the expense of future generations. My guest this morning is Moritz Kramer, Chief Economist at LBBW. Moritz, good to have you with me. You really do paint a pretty bleak, torrid situation, not just for the U.S., but globally, in terms of the debt situation. This is what you're saying. The fiscal situation in the U.S. is even more unhinged. The debt ratio has doubled since the GFC to over 120% of GDP. Trend is rising as fiscal policy is irresponsible. More tax cuts may be on the way if Trump wins. I mean, are we going to hell in a debt handbag again? What is the risk to the world? Good morning.
Good morning to New York, Menace. Yes, I think the risks are rising. I could just underwrite what we just heard, the quote. It's it is really not only in the US, it's also in the Eurozone. It's basically everywhere, even in emerging markets. Despite this long period of ultra-low interest rates, public debt has risen to levels that we would have thought impossible only 10, 15 years ago. And this was during the good times. Now, it's going to be many more headwinds hitting us. Rising interest rates, of course, but also aging societies, which will cost a lot in terms of pensions, healthcare, long-term care, but also probably more defense spending. And at the same time, the number of people in the workforce will probably decline for the reasons of the demographic change and the aging. So this is really not sustainable, and something's going to happen. Otherwise, we're going to hit another crisis. And in the Eurozone, probably earlier than in the US, because the US still benefits from the reserve currency privilege. But even so, it's like a rubber band, and even the strongest rubber band, if you pull it too hard and too tight, it's going to snap at some point.
How quickly does this metastasize, Moritz? Because it's a very clear thesis. It's based on the rigidity of numbers of debt to GDP and extrapolating that forward. We saw the European debt crisis unfold for a very different set of reasons in the late 2000s, but 2007, 2008, into the early 2011, 2012. How quickly will bond markets grasp what you're saying?
Well, the bond markets are currently in a pretty carefree environment. If you look at sort of in Europe, we look at the benchmark spread usually between the Italian bond and the German 10-year bond. And this so-called BTP spread was like twice as high 2 years ago as it is now. So clearly there's not much concern currently. But if you look at recent releases from budgets, and we already heard the huge deficit in the US in a situation of full employment, but also in Europe, we had a very negative surprise in France, where the deficit last year came out 5.5% of GDP, much higher than expected. In Italy, a whopping 7.2%. And now this interest rate additional cost will kick in. So if you assume that the yield curve moves up by 200 basis points compared to the low interest rate environment, and that's not unrealistic, this would add, once everything is rolled over, in France to 2% of GDP extra spending just on interest. In Italy, it's 3% extra spending just on interest. This clearly requires much more rigorous action to contain the public finances. Otherwise, investors will become nervous. And we know from the Eurozone crisis and many other crises before, this is not happening in a slow linear fashion. This can be triggered by political or other events and can go very, very quickly. And right now we have a situation where the ECB has already sort of pretty much thrown in its weight through QE, etc. It's going to be very hard to repeat this from the starting level where we're now. So the risks are rising. And I think there's not enough anxiety in the market about what this would mean in the medium term.
And this is what I'm really sort of trying to grasp a hold of. We saw a very existential moment in the gilt market, right? That was under Liz Truss and Kwasi Kwarteng. Are you saying that it's some kind of existential event that could trigger a crisis, or is it a slow brewing pot of horrors in the bond market?
Well, the UK situation probably was special because this was such a horrendous policy mistake for everyone to see, other than the government, apparently. So there's always the risk of a policy mistake happening. But I think in the US, for example, it's going to be much more gradual, because if you have a situation where uncertainty rises, where the nervousness rises, usually you have fleeing to safe havens, and the US government bond market still is that, even if the risks emanate from the US as they have in the past. But remember the Eurozone crisis, when it all was triggered really by some revisions of Greek fiscal data. Now Greece is probably 1% of the Eurozone, and still it was enough to set in motion a crisis that kept the continent sort of in crisis mode for a couple of years. So we cannot predict what will trigger it, but it's not going to be a slow process.
How do you think the bond markets are going to react? I mean, you've done some modeling on a Trump election. You call it Trump Reloaded. You currently predict a 53% probability of Trump winning. Although you say that is a declining trend, I'm curious, first of all, how much of a declining trend is that, and to what extent would a Trump victory, I suppose it depends on the complexion of how the Hill turns out, but how would that play out for bond markets in the first instance and risk?
Yes, well, the probability of a Trump win is still more than even currently. But there's a lot of volatility also in the polling numbers, and of course the electoral system is very complicated. So I think it's certainly not a foregone conclusion that the man will win. There's a lot of things that can still happen between now and November 5. But if he were to come back to the White House, I think there's at least a 50% chance that he's actually going to do what he says he's going to do, and that would be pretty detrimental. It would mean high tariffs, not only against China, I think that's a given almost, but against Europe as well, and pretty much everyone who runs a trade surplus with the US, which is pretty much everyone. You'd also see probably more fiscal stimulus through tax cuts, which are quite unaffordable at this point in time. And this would, in my mind, lead to a lot of thinking on the Fed side, because clearly the cycle of lowering interest rates, which we expect will start in July, will be torpedoed by such an environment, because tariffs are inflationary, and of course the fiscal expansion would also be inflationary. So I would think that coming into next year, that you would not only see the Fed slowing down, dialing down the rate cuts if he is going full on, but also that at the long end, the rates will rise and we'll see a steepening of the curve as concerns about fiscal probity will rise.
So take it as Banu Baveja stepped out of that seat, you'll take the other side of the trade from him, where he was calling potentially for 5 rate cuts in 2025, and the tail risk is growth. You would disagree with that?
Well, man, it depends on the scenario. We're saying this is like a 50% chance that he's actually going to do all these wild things that he claims he's going to do. But he's a transactional man in my mind. So he may also be much more moderate and say, okay, look, you've got to do something about the trade deficit. Yeah. And he may be going into deals as he's done with the EU in 2018, and then it wouldn't really come to that, and we would see a continuation of the rate cutting cycle also into next year. But the problem is we can't really know what he's going to do. Maybe he doesn't even know what he's going to do. So, so I think the uncertainty and the possible volatility in the bond market next year, and also closer to the run-up of the election, will be much higher than what we were used to in the last couple of months.
Moritz, great to see you again, and thank you very much for sharing your thoughts on the time bomb that is debt in the bond markets. That is Moritz Kramer of LBBW. Coming up, the details on UBS's buyback plan. We'll discuss that next on Bloomberg. Good morning.
When you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center.
And that's news when you want it with Bloomberg News Now. Get it 24/7
on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal.
The deal. That deal. The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
It is Bloomberg Brief. I'm Menace Cranny in New York. So UBS are pledging a $2 billion buyback plan. That's for this year, and it targets completion of its takeover of Credit Suisse in the second quarter. Joining me now is Charlie Wells. Charlie, good to see you. The messaging from the buyback. Why is the stock down on good news on a buyback? Hard question.
Yeah, hard question, but also hard year, right? I mean, 2024 management of UBS has been broadcasting is going to be a very difficult year compared to last year as they try to complete this integration. You know, the heavy lifting, the chairman said, is about to come. They've got to dissolve the Credit Suisse legal entity into UBS, and they've also got the difficult task of trying to integrate the old IT systems from Credit Suisse into UBS. Investors have also been grumbling a little bit about some of the profitability targets for UBS, and so this is a way that they can try to, you know, at least keep some focus on the positivity coming out of that integration.
And of course, it is just over a year from that fated weekend when the forced marriage happened, and that was the delay on buybacks and the dividend. And that's one of the key reasons why you want to be long that stock, but huge capital appreciation on the stock since the merger. Let's talk about Citi, because again, more job cuts coming through at Citi. What does it say about Jane Fraser? I mean, she was quite bullish in terms of the time frame of the restructuring, but does this add to that narrative?
Look, earlier this year, Jane Fraser said that she was going to move quickly, but she was going to move thoughtfully on this restructuring. The plan was to cut some 20,000 jobs, and what people familiar with the matter told Bloomberg is that last week there was a fresh round of cuts in the investment bank, that technology, media, and telecoms were particularly hard hit, and this is just an indication that this seems to be moving very quickly. It comes as Credit Suisse recently said that it had completed the major actions of this reorganization, and actually, as far as scope, we're getting a little bit of indication here on some cuts as well. Citigroup actually had to file with New York State their plans to cut 430 roles. So it's seeming like this is coming to an end.
Okay, and then over at McKinsey, if you're not up, you're out. What's going on?
That's their famous motto. I mean, look, according to the Times of London, they put out a report that they were offering 9 months of salary and some career coaching to some management as long as they promised to leave the firm. Now, this comes after last year, McKinsey embarked upon a plan to lay off 1,400 people. Those are rare layoffs, but what we do know is that the consulting industry has been under a lot of pressure as the companies that they advise cut back, and there's been a lot of questions about consulting firms in general. So this is definitely a part of the difficulty that the industry and McKinsey are facing right now.
Wonderful remarketing of being fired. Strategically encouraged to reconsider the direction of one's career. Charlie, thank you very much. Charlie Wells on UBS and Citi, the moves there. Shares in Tesla, they're falling pre-market. Trading, some analysts are bracing themselves for the company's first sales decline since the early days of the pandemic. This could be a fill-or-kill moment for the stock. Craig Trudell is with me. Craig, a lot of pessimism, and it's permeating this morning pre-market. So what do we think we're going to get?
Yeah, I think the most sort of remarkable move that we saw among the analysts last month was Deutsche Bank. It's unusual that you see an analyst cut an estimate not once but twice in the span of just a few weeks. The beginning of the month, they were seeing 476,000 units. They moved that down to 427,000 on March 11th. Last week, they went all the way down to 414,000. That would be down from a year ago. The last time that we saw Tesla report a year-over-year decline in deliveries was the second quarter of 2020. It's really, not a development that we're used to seeing from this company. That being said, the company did say early this year that this is going to be, a markedly slower year for them. And I think the big concern for investors is whether there's, sort of something to glom onto between now and when this next generation vehicle that Tesla's been talking about for years now, whether or not they can accelerate that from, on the last quarterly call, Musk was talking about that being a late next year introduction, whether they can move that up or offer something to keep investors excited in the meantime is going to be key.
I mean, the headwinds are coming hard and fast. You've got other competitors coming out with incentives. You've got price cuts by Tesla inside China. You've got BYD snapping at their heels. Have they got a demand problem for Tesla, or have they got other production issues? I mean, where is the biggest headwind for them?
I think it's a combination of, sort of letting the lineup languish a little bit. The Model 3 and Model Y have been out for quite some time. They're both, if we sort of take a step back and look at how they're doing, they're actually, doing quite well. The problem is they don't have reinforcements. The Cybertruck is not a high volume model. They're also, after all the price cutting they've done, they're much higher priced than, in China, a lot of, their competitors are much lower than they are. And so they have a problem of product, also of price, and I think just the general sort of EV slowdown, a real question as to whether or not, the early adopters who would be interested in EVs, whether that demand is satiated, and whether the industry as a whole is having some trouble converting more of the consumers that have been reluctant to go electric, to make that leap.
Look, he's famous for his ability to make decisions literally overnight and on the fly. He's quite Machiavelli. What do you think Musk's strategy is going to be on this to ride it out?
Well, I think it was interesting that last week, Bloomberg scooped this idea that he was going to, enforce this requirement that in North America, if you wanted to buy a new Tesla, you had to take a spin to be shown full self-driving, which is misleadingly named. It is not self-driving, but it is a driver assistance system that Tesla feels really good about and is something that Musk wants to really promote and get people excited about. It's also a way for them to potentially boost pricing, because this is a feature that they still charge $12,000 for, or you can subscribe to it for $1,200 a month. And so this is a product that perhaps is a way that they can use to kind of boost margins as sales growth slows and potentially even slips in the first quarter.
Yeah, the subscription models are the best models. Now, you mentioned the Cybertruck obviously isn't going to be the winning volume play for them. But then I look at Xiaomi, they have their first ever EV, the SU7. How much of a threat is that to the Cybertruck?
I think the reports overnight of just how many orders there were for that, right off the bat, really speaks to the level of interest. And we saw also just, this is part of a pattern of, we saw Huawei late last year start to bring EVs to market. And so, it's really kind of ironic that, there was all this anticipation of, the Apple car that has, fallen by the wayside. But we've seen not one but two major Chinese smartphone companies enter the EV market. And it's really no surprise to see that, in the sense that, this has become a strategic industry for China and for Xi Jinping, where he wants China to really sort of dominate the global market. For the moment, we're just going to see those companies play in China, but there's absolutely ambitions, more broadly for China to become more of a player on the global automotive stage.
Craig, thank you so much. That's Craig Trudell. Well, we're counting down to those quarterly delivery numbers. The stock is under pressure at the moment. Snapshot of risk. This is what we've got for you. Moritz Kramer joining me, warning of a debt crisis, potentially more so in Europe than the rest of the world. So S&P 500 down by 1/10 of 1%. Bonds level out at 433 after a pretty virulent spike yesterday by 11 basis points on the back of the higher prices paid in strong ISM data. And the dollar is flat at 12.48. Coming up, we take a look at the market moving events throughout the day. A lot of Fed speak on The Ticker. Good morning from New York.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like a learning.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
With AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry, meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stage ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
And we've got to work out what that means for the stock market.
Especially if it comes with inflation. And that's the reason why the commodity sector matters. And I would take it a step further and say, how much does this support the idea of a broadening out in the market rally, which all of the guests yesterday on the show with you guys were talking about, and how much does this really stymie it, derail it at a time where people are hoping that yields remain lower and that the Fed can cut?
We'll get into that conversation in just a moment. Equity futures on the S&P 500 this morning, at least, a little bit negative. We're down by 0.2% on the S&P. In the bond market, yields just bleeding a little bit higher once again, up 3 basis points. Your 10-year very close to the highs of the year at 433.91. Coming up this hour, Phil Orlando of Federated Hermes on stronger than expected factory data. John Lieber of Eurasia Group as the US and Israel look to ease tensions. And Abigail Watt of UBS looking ahead to payrolls Friday. We begin with our top story. Investors pushing back Fed rate cut bets. Stronger than expected factory data weighing on markets ahead of this week's jobs data. Phil Orlando of Federated writing this. We're not buyers of the SPX whole hog here. However, we still expect the rally in stocks will broaden out from Mag 7 centric to include domestic large cap value, small cap growth, and international. Phil, I'm pleased to say, is with us now for more. Phil, let's get straight to it. The data of yesterday, how much weight would you put on that manufacturing read?
John, good morning. Thank you again very much for having me back on. I think yesterday's data was very significant, that the ISM, as you guys pointed out, was back above the 50 level, the contraction line of demarcation, if you will, for the first time in 16 months. And as Lisa pointed out, the number that was stunning was the prices paid component. So you've got a situation where the economy is strengthening, yet inflation is sticky, perhaps even accelerating. Now, pair that with the LEI data we saw last week. Leading economic indicators went back positive for the first time in 22 months. And you sit down and talk to our bond people, and they look at these inverted yield curves that we've been watching for the last 2 years. Funds to 10s, 2s to 10s, 3-month to 10s. They're flattening out. Our bond guys think that those may become positively sloped again. So the risk of recession or lower risk of a modest soft landing is starting to shift to a stronger period of economic growth. But the inflation question, I think, is the more important one. Look at last week's PCE print, core, 2.8% for the month of February. Now, what really caught our attention was the changes in the SCP at the Fed's last meeting. They're increased their core PCE forecast to 2.6% for next year and kept their 2% target in place for calendar 26. So the Fed is telling us that inflation is still a problem. It's going to be a problem as the economy comes back. And what all of that means is that there's going to be less rate cuts relative to what the market was expecting just a couple of months ago.
So, Phil, given everything you've said, every item on that list in the last couple of minutes, is that good or bad for stocks? Let's make it really simple. Good or bad for stocks?
So, the S&P 500 up 10% here in the first 3 months of the year, up 28% since October. In our view, stocks are ahead of themselves, but we expect sort of a rolling correction, if you will. The Mag 7 in the last 15 months is up 99%. The forgotten 493 is up 22%. Our view has been that this rally would broaden out, that we would see some profit taking in the Mag 7 and the domestic large cap value stocks, the small cap growth stocks, the international stocks, which were largely left for dead over the course of the last year or so. They would find some love, and we'd start to see some improvement in the share prices of those categories.
But Phil, how much do higher rates really challenge the idea of broadening out, particularly to small caps, considering that these companies usually are more leveraged and are more vulnerable to higher rates?
Fair point. But remember that the U.S. economy is doing relatively better than a lot of our trading partners, Japan, Germany, UK, all in a recession. The reality is that small cap companies here in the United States do 80% of their business right here at home. And from an economic standpoint, we're doing better here. In terms of underlying fundamentals, the sectors within the small cap market, biotechnology, for example, is our favorite, is really well positioned. Biotech stocks have very strong pipelines. The valuations have probably never been cheaper. And with interest rates down at the margin, the prospect of M&A activity is enhanced today versus where they were a year or so ago. We do like small cap here.
What about oil? How much is oil the new Mag 7 at this point, where people are talking about the fact that suddenly there is the reality check of supply and demand and the fact that this economy isn't rolling over the way so many people thought?
Music to our ears, Lisa, that we were very lonely at the beginning of the year talking about oil, WTI in the mid-60s, thinking that we could see $80 to $90 a barrel by the end of the year. We're now sitting in the mid-80s 3 months into the year. So this has happened a lot quicker than we thought. But the combination of increased geopolitical risk in combination with the fact that we don't have a lot of levers here. In the past, we might have utilized the Strategic Petroleum Reserve to perhaps adjust the price of oil. We took the SPR down 350 million barrels a couple of years ago and didn't replace it. So at this point, we are sort of at the mercy of the vicissitudes of what's going on globally. Crude oil last September was at $95 a barrel. We could see the crude oil market retest that. Gasoline prices at $3.50 or so a gallon now could be at $4 over the course of the next couple of quarters. So this move in energy for us is real, and energy has been one of our favorite categories on the domestic large cap value side.
Well, Phil, with Brent already trading within your range of $89 a barrel, what do you see for year end?
Higher. We think that
100?
WTI could trade up another $10, and Brent, maintaining that spread could probably approach $100 a barrel.
Phil, when we were talking in early November and you were talking about double-digit rallies on the S&P 500, did you ever expect things to go as far as they have in the stock market?
Not as quickly as it has. That we've got a 6,000 target on the S&P, fully discounting calendar 2025 earnings. The market seems to be focusing on that number. We didn't think that we would get up, the 52, 5,300 level in the first quarter of this year. So the rally, this 28% rally we've seen over the last 5 months, has been much faster than we had expected last fall.
So much faster. Great to catch up, Phil. Thank you, sir. Phil Orlando there at Federated Hermes. I actually missed this. This came from Jim Reed at Deutsche Bank. Up more than 10% in Q1. Knew that. Marking the first time in over a decade that it's been back-to-back quarterly gains in double digits. First time in more than a decade, Bramo. Then I had to backtest that and look at the numbers because I wasn't convinced. I was going back to the pandemic, thinking about how we came out of that. Haven't seen back-to-back double-digit quarterly gains in more than a decade.
It's kind of a shocking statistic. I mean, we kind of get sort of numb to this idea, okay, it was the biggest start to a year going back to 2019. What's new? Okay, that was the pandemic era, a lot of disruptions. But to talk about another era, and we saw that with the Japanese stock market too, Jim Reed pointing out the fact that the Japanese Nikkei is up the most going back to 2009. We're talking about post-great financial crisis recovery types of levels here.
Just absolutely phenomenal. This morning, just a little bit softer. We're down about 0.2% on the S&P 500. Let's give you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Iran vowing revenge against Israel, blaming the country for a deadly airstrike on its embassy in Syria. The strike in Damascus late Monday killed at least 7 Iranian personnel, including senior military commanders. Israel has yet to confirm the attack, but the country's forces have struck Iran-linked targets in Syria in the past. If confirmed, this would be the first time that it's directly hit an Iranian diplomatic facility. UBS says it plans to buy back up to $2 billion of its shares, with up to $1 billion of that total expected to take place this year. The Swiss bank confirming the share repurchase plan today after having suspended its previous plan a year ago amid its government-backed takeover of its former rival, Credit Suisse. The bank expects to complete the merger by the end of the second quarter. Former President Donald Trump has posted a $175 million bond to put a massive civil fraud verdict on hold while he appeals it. The move preventing New York State from seizing his assets, at least for now. Plus, it halts the collection of the more than $450 million he owes after a judge ruled he inflated the value of his assets for years to get better loan terms. Trump is still on the hook for the full amount, plus millions in interest if his appeal fails. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, the US and Israel easing tensions.
We've been very clear about our concerns about a military operation into Rafah. There are more than 1 million Palestinians who are in Rafah right now. And so we want to make sure if there is going to be a military operation, we have to understand how they're going to move forward.
That conversation up next, live from New York City this morning. Good morning.
Was going to keep Rain World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's Jobs Day, and Bloomberg has the report under surveillance.
Jobs numbers have exceeded expectations consistently.
The U.S. is just exceptional. Look around the world.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
When you see numbers like this, is that no longer a reason to be hawkish at the Federal Reserve?
It's a reason to be cautious, maybe not hawkish.
The March Jobs Report, Friday, only on Bloomberg.
Well, I said we were hitting the ground running for Q2, and we definitely did just yesterday, didn't we? I said manufacturing shaking things up big time in the bond market. Double-digit gains on a 10-year yield. We had another 3 basis points to that, 434.51, and the equity market down just a little bit again. We're negative by 0.2% on the S&P 500. Under surveillance this morning, the US and Israel easing tensions.
We've been very clear about our concerns about a military operation into Rafah. There are more than 1 million Palestinians who are in Rafah right now, and so we want to make sure if there is going to be a military operation. We also know that there are Hamas operators in Rafah as well, but if they're going to move forward with a military operations, we have to have this conversation. We have to understand how they're going to move forward.
Here's the latest this morning. Israeli officials agreeing to take White House concerns into account ahead of its planned invasion of Rafah in southern Gaza after meeting virtually on Monday. In a joint statement, the White House saying both sides, quote, share the objective to see Hamas defeated in Rafah and plan to hold follow-up discussions as soon as next week. Joining us now to discuss is John Lieber of Eurasia Group. John, if that's easing tensions between Israel and the United States, tensions certainly weren't easing between Israel and Iran. Let's talk about the strike on an Iranian consulate in Syria by Israel. John, can you tell me about the prospect, how great the risk is that this ends up in a regional conflict?
Well, Iran's behavior to date has not suggested they're looking to increase to get into a regional conflict. The Israelis killed another senior commander in Syria in December, and the Iranian response was relatively muted. This is probably the most senior person that's been killed since Soleimani during the Trump administration. And the easiest vector for Iran to respond with would be by attacking U.S. forces in the region. And just last night, there's been reports of drones going after some U.S. bases. So that's probably the first order response, is how the Iranians can go after this, is to escalate tensions again against the U.S. There's been a bit of a pause in these types of strikes since earlier in the year. And the other vector for escalation that's really the more worrisome one would be one of Iranian proxies like Hezbollah attacking Israel from the north. So I think that's the major concern to watch. But so far, Iran has not seemed to want to escalate in that manner. And for now, it looks like the U.S. is probably going to be its main target.
But given that Mohammad Zahedi is basically the highest ranking individual that's been assassinated since Qasem Soleimani, which you're talking about, which the Israeli press is talking about, is there potential for more direct confrontation between Iran and Israel, not through proxies?
I mean, that would be a really unprecedented escalation, especially given that the Iranians have so many proxy forces in the region. It's always possible, but that has not been their MO for a while now. Their MO has been to attack through these proxy groups. They're heavily armed, well-trained, ready to go. And it seems to be the Iranian preference. Even after more senior commanders were killed in recent years, the Iranians haven't tried stoking direct confrontation because they don't seem to want to. Now, of course, that could change. Everything that's happening in the Middle East right now is unprecedented, but the pattern of behavior has been pretty clear. The Iranians don't seem to want that type of conflict.
While this is happening, it does seem like the temperature was taken down between Washington and Jerusalem, this relationship that has been very acrimonious, especially in public, between Netanyahu and Biden. We now have those officials heading to Washington next week. How important is it for these two countries to show a united front at this time when we see this escalation in the region?
It's certainly important for Israel. I mean, for Washington, it's a lot more dangerous, I think, particularly for the Biden administration, given that this remains one of the key political vulnerabilities that they face. And you've seen the Biden administration shift their views on their support for Israel, including by abstaining at the UN Security Council vote last week. So for Washington, their relationship with the Israelis, and particularly Prime Minister Benjamin Netanyahu, is a political liability, but it's obviously one that they're willing to take on because of the support for Israel runs so deep in Washington. Now, public opinion in the U.S. is starting to shift, with more Americans questioning U.S. support for Israel, given the images coming out of Gaza, but that hasn't deterred the Biden administration. And I will say that they've been effective so far. I mean, the Rafah operation could have started 2 or 3 weeks ago when the Israelis were looking at amassing troops down there, and it hasn't yet. And you've got to think the only reason for that has been the strong U.S. pushback and concerns about stoking another humanitarian crisis.
To put these two ideas together, you did mention something that was really important, the idea of a potential escalation on the northern border with Lebanon, with Israel, and some sort of a direct attack from Hezbollah on Israel. How much power does the U.S. have to prevent Israel from actually going on the offensive, which is what a lot of people have suspected is the next step, and that this latest strike shows a willingness to do?
Yeah, I mean, the U.S. has not looked particularly effective in slowing Israel down, other than this Rafah operation. I mean, I would say they had some success in the Rafah operation, but Israel is intent on rooting out Hamas, and they're intent on re-establishing dominance and deterrence in the region. And nothing the U.S. is saying right now is inclined to stop them. In fact, the U.S. continues to ship them more offensive weapons, even as they do increase domestic calls for a ceasefire in order to arm Israel and allow it to continue this offensive. So we don't get the sense right now that Israel's looking to stoke a conflict on the northern border. It seems like the mission is focused in Gaza, but that could be, depending on the perceived threat to Israeli security, that could easily be another front that opens up in this war.
Halima Croft of RBC Capital came out with a note that I thought was fascinating. She pointed to this as being the biggest potential escalatory risk. And the reason why she sees this as actually a considerable escalation. When it comes to domestic politics, how much power does this administration have to counter gasoline prices that have been on the rise, that will continue rising, inevitably on the heels of any further escalation?
The American administration or Netanyahu?
Yes, the American administration.
Yeah. I mean, I think that, look, rising prices are obviously a huge vulnerability for Biden. It's one of the reasons that everybody's so worried about bringing the Iranians into this, is because the Iranians don't want that oil to get off the market, and neither do the Americans, because they need prices to remain low during an election season. But that doesn't seem to have a lot of implications for a conflict purely within Israeli territory, including on the northern border. So I think the Americans are desperate to keep the Iranians out of this, to keep this as a regionally contained crisis, but the Israelis have a singular focus on their own security, and that's what's driving them right now, and that's going to be what continues to drive them, no matter what the Americans say.
Yeah, one side of that conversation is not worried about the oil market at all. John, thank you, sir. John Lieber there of Eurasia Group. Let's get to the commodities board and talk about what's happening with crude. The WTI through $85 for the first time since October. Brent crude getting closer and closer to 89. And what we're seeing in the commodity market, pair that with what we're seeing in the Treasury market, new highs for the year on a US 10-year. Lisa, just moments ago, very, very close to 4.35.
The idea of a 10-year yield, 30-year yields spiking yesterday on the heels of some of these concerns, not only about the ISM prices paid, but also the ongoing pressure with oil prices and this inability to see how you de-escalate this. When you have one actor in the space that has a singular focus, Iran is trying maybe not to escalate, but there's a real question of how and how this remains contained if the U.S. doesn't have more influence over Israel at this point.
Yeah, it might be a stretch to call this a haven trade, given the fact that Treasury sold off yesterday, yields rose, gold rallied too. I find the inflation component of this story to be quite interesting. It started going into the Federal Reserve meeting. We had gold hitting all-time highs. And I just wonder if we keep going back to the same line from Chairman Powell, the same question we had coming out of the news conference. Just how committed are they to that 2% inflation target? Because the language around it has changed. We've been talking about this for a while. August 2022, it will require pain. And now the story's changed. And I get it, the inflation numbers have developed too. But the story now is it will require time. The emphasis is on time and not on pain.
Which is the reason why you're starting to see these shifts subtly under the hood, right? It's not a wholesale rejection saying the Fed isn't going to necessarily have its target there. But look at, for example, five-year forward break-even rates. Just creeping up a little bit. You get this sense, especially with the oil market, people starting to realize, wait a second, something is percolating here under the surface, and it's really reflected in bonds that still are down 11% since the end of 2020.
Abigail Watt of UBS joining us a little bit later on this hour to weigh in on the Federal Reserve and what this inflation story means for the Fed going through this year as traders push back once again the prospect of rate cuts, cutting the probability of a rate cut in June in half, just a 50% chance now. The broader equity market on the S&P 500 weaker yesterday, weaker again this morning. We're down by 0.2% on the S&P. In the bond market, new highs for the year on a 10-year, 4.35. That new high for the year, the print just moments ago. Coming up on this program, up next, Bloomberg's Craig Trudell on an EV surprise in China and Tesla deliveries coming out a little bit later this morning. Tesla is down by 1.6%. From New York City, this is Bloomberg.
Trends in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What a difference one ISM print makes, hey? Snapping 16 straight months, 16 consecutive months of shrinking activity, just like that. Equities down again this morning, negative by 0.2% on the S&P 500. On the Nasdaq 100, negative 0.25%. The price action in the bond market right across the curve. 2s out to 30s. We were looking at something like double-digit gains on a 10-year yield, all the way out to 30s. We're up again this morning by 4 basis points. The 10-year, 334.71, and just moments ago, literally in the last 20 minutes or so, new high for the year, 434.91. Yields up, Lisa, 4 basis points.
And it doesn't seem to be really hampering this idea of a broadening out in the equity rally, which I think is interesting. We're not seeing the same kind of fear that we used to, which raises this question: how much are we seeing a point that people have dismissed the idea of stagflation? All of those concerns with higher commodity prices are no longer on the table, and it's just finally the commodity sector realizing how much strength there is in this global economy led by the United States that's percolating out everywhere else.
So we're starting to see inflation, right? The stag is the debatable piece of this. Prices paid sort of add to the inflation part of the story. The stag's hard to say stagnant when you see a manufacturing recover, when you see the labour market data that we have seen so far. That could change on Friday, but at least so far pretty solid.
Which raises the question, Bill Dudley answered this with you guys yesterday, are we really sufficiently restrictive? Does this really give the sense that the rate currently on 10-year yields, on 30-year yields, on 2-year yields are hampering the growth rates of the United States? It doesn't seem like that's the case.
I think we have to accept the way you look at things is different to the way that Chairman Powell looks at things. Think about how he answered a question on financial conditions. This came up with Bill Dudley yesterday as well. You asked the chairman about financial conditions and he says they're tight. Then we look at what's happening in broader markets, stocks all-time highs, credit spreads at multi-year tides, the amount of individuals, companies that came to market in Q1 of this year and issued debt, getting ahead of maybe a crunch a little bit later this year. That doesn't smell that tight to me just on first look.
Which is the reason why, as you pointed out, people are ratcheting back expectations for rate cuts this year and now are back to pricing in fewer than even the Fed sees. Does this matter? I mean, this again, we've gone from this is dependent on rate cuts too. As long as the Fed begins a rate cutting cycle, even with one rate cut, that's going to be sufficient to send risk assets to the moon. Is it? I mean, I challenge that. I wonder whether you can see a real broadening out if you see the companies that are most vulnerable to higher rates, face off with much higher rates.
I just have one question for anyone on the FOMC. Just how lonely is President Bostic right now on the Federal Reserve? Signaling what? One cut this year? Just how lonely is he at the Fed, given the data we've seen?
It sounds like Neil Kashkari's on board with him.
Right.
They probably are in the corner by themselves eating lunch kind of bitterly. Why doesn't anyone see what we see? And everyone in the market sees it. Why won't they come around to our view? But, do they have to do more than one rate cut? Right? I mean, I guess that's one question. Is one rate cut the signal of the process, or can it just be one rate cut? And Bostic and Kashkari are there in the lunchroom eating their chicken sandwiches.
They were at Jackson Hole. Do you remember this? They were eating lunch together, and I was trying to listen into what they were talking about, but I couldn't hear a single.
This is what they were talking about.
But but that was last year. I've got no idea if they were ahead of the curve that much last year. Let's get to Anne-Marie's board. We need to talk about what's happening in commodities. Got new highs for the year on Brent, on WTI. Brent getting closer and closer to 90, $89 a barrel. Went through 85 on WTI. Copper back through 9K. Saw that in March as well. AMH, what's happening in gold? All-time highs once again. It's quite a run on gold at the moment.
Quite a run. We've seen this also when a pickup after China reported their manufacturing numbers. We see as central banks come out and buy more gold. Everyone's talking about potentially this is an inflation hedge. But to Lisa's point earlier, it's not just gold. It's not just copper. It's across the entire commodity space. And obviously oil definitely in focus today. And a lot of people are starting to say, wow, we're already at my year-end target for where I thought oil was. And we're going to have to look at that upside risk. This whole feeling where ISM is, where prices paid is, where oil is, reminds me of the summer of 2022. And that's going to be troubling for this White House.
Big time. Gold right now up for a sixth straight day, up by another 0.4%. Under surveillance this morning, hotter than expected factory data weighing on markets, pushing back rate cut bets. The ISM manufacturing gauge showing an expansion for the first time in 16 months. Investors will be looking ahead to Fed speak today from Bauman, Williams, Mester and Daly, plus factory orders and JOLTS at 10 a.m. Eastern time. How important is JOLTS data? It's not for me to say. The Federal Reserve Chairman answered that question for you. He believes it is important because he's pointed to that as evidence that maybe this labour market story is starting to soften just a bit.
Okay, so here's a question for you, because I have to say, I was reading a lot of notes about the ISM manufacturing data that came out yesterday, and so many people were explaining it away as data that was noisy and irrelevant. If we get higher than expected job openings, do you start getting people explaining it away as an insignificant number because they're looking at the desire of Fed Chair Powell to cut rates? You know, at what point do these data points matter versus be, you know, serving as anecdotes along a bumpy path to what Fed Chair Powell wants to do and it's going to do anyway?
And not my opinion, just an observation, but I think we're on the same page. The Federal Reserve Chair has basically characterized as anything that goes against the grain, the trend, as a bump in the road. He's used that word bumpy quite a few times.
And everyone's on board with that. I mean, so many people are saying manufacturing, we expected this was a blip, we're not going to get more, oil prices are transitory, this is just simply an issue of things resurging, chocolate prices, you know, have Easter and then move on. But at a certain point, is there something real here? And that, I think, is something that an increasing number of people, I'm thinking of, for example, Jim Bianco, are really thinking about.
It feels like a turn. It feels like a turn. It's early days, but it certainly feels like a turn. Let's get to this story. United Airlines is asking pilots to take unpaid time off next month. The airline's saying staffing cutbacks could extend it to late 2024, thanks to delayed deliveries from Boeing. United announcing earlier this year that flight hours would be trimmed. United is set to receive 80 MAX 10s this year, but is now looking to convert those orders to smaller planes. If it means, Anne-Marie, it will receive the jets sooner. United is down by about 0.75%.
And it's astonishing, really, that they're telling pilots. Remember, there was a crunch after COVID. People started flying again, and they were like, we actually need more pilots. Now they're saying, well, we're not going to have the planes, so we don't need the pilots. What does this mean going into the summer? Higher airfares.
Fares are going up. Helene Becker said it a few times on this program.
And you get under, well, here's my concern. If you have
I know your personal concern. Do you mean like your broader concern about the economy?
Well, I have personal concerns about the experience of flying, which is deteriorating rapidly. But I also have concerns about high talent getting shafted, yet again, to your point, Anne-Marie. I mean, this idea of if you have people who are put to the sidelines yet again, how many people remain in the workforce? And if you have that sort of experience leaving the workforce, do we end up with more Boeing-type issues, right? I mean, this is sort of one of the key questions that people have been asking.
We've had chaos in that industry through the pandemic and out the other side post-pandemic. Let's get to crude. Crude futures hitting $85 a barrel for the first time since October. OPEC production cuts, ongoing conflicts, particularly in the Middle East, continuing to lift prices. Brent nearing $90 a barrel at $88.94 this morning. And US gasoline demand up for 6 straight weeks. You mentioned the politics. I think we have to talk about it. Very, very close to a story of, say, $4 a gallon in the summer at the pump for Americans. Now, we know last time around they reached for the strategic midterm reserve and basically unloaded it onto markets. And you know what? To some extent, to a great extent, it worked. Do they even have that option this time around?
Now it's going to be called the Strategic Presidential Election Reserve, and they do have that option, but they're starting at a different base. So we have seen the U.S. go out. They've been refilling the Strategic Petroleum Reserve, but they brought it to a 40-year low. So the base on which they can draw from, that ceiling, it's much harder this time around. Also, they've already done it, and they've gotten a ton of pushback about it. So if they do it again, it is going to look very political. What's the blame now? I guess it'll be the crisis in the Middle East.
Does it matter? I mean, I guess that's really a question. We can talk about whether it's political or not. If they say, yeah, it's political, and we want you guys to have lower prices, are people at the voting booths really going to care? I mean, that's essentially where we've been. They can talk about the midterm, the strategic midterm reserve fund, and we can talk about it with some kind of irony, and they probably would say that it worked. I mean, we basically sold high and bought low. Let's talk about the strategic presidential reserve. I like that. I like that. We'll be talking about that in a few months, I'm sure. Brent crude right now just south of 89, WTI $85 a barrel. Elsewhere, shares of Xiaomi jumping as much as 16% in Hong Kong. Orders for its first electric vehicle topping estimates. The company saying it received nearly 90,000 orders within the first 24 hours. Meanwhile, Tesla facing another setback. Analysts lowering projections for vehicle sales in the first quarter, with waning demand and higher rates taking its toll on purchases. Bloomberg's Craig Trudell joins us now from London for more. Craig, we can talk about the competition in China in just a moment. Let's talk about the number that comes out later this morning from Tesla. What are you looking for?
I think the general sense is absolute pessimism. I mean, the number of revisions that we saw just in the last week or two, I counted at least 9, and interestingly, one analyst at Deutsche Bank actually cut twice in the course of just a couple of weeks. So initially they were they were looking for 476,000 units. They cut that down to 427,000. Last week, they went down to 414,000. That last number would be actually below where they were a year ago. The last time we saw Tesla report a year-over-year decline in deliveries was the second quarter of 2020. So that is not a milestone that we see out of this company, very often. And it speaks to the sort of tired nature of their lineup. The Model 3 and Model Y are getting a little bit long in the tooth, and they don't have reinforcements on the way to kind of get consumers interested.
How much of this truly is a Tesla problem, and how much of it is just a broader EV issue?
I think we're absolutely seeing the case that there may be some issues with finding the sort of next incremental EV buyer. The early adopters to some extent maybe are satiated, and these companies are having a little bit of trouble finding the consumer who's willing to take that leap and go electric. I think we've seen this across the board. Even BYD, which has just been on this incredible run the last couple of years, even they had a bit of a setback in the first quarter in terms of where they were last year, particularly to end the year. And so we do expect actually, for all of the negativity around Tesla going into this print, we do expect them to outsell BYD for the first quarter and take back leadership of the global BEV market.
Greg, it's really interesting when you're talking about this being an EV market problem. It raises even more questions about Xiaomi, which is a smartphone company that came out with a new phone, with a new car that actually did much better than expected. How can we understand that? Is this an idiosyncratic company, or does it highlight that the barrier to entry to this business isn't as high as it used to be?
I think it's really interesting what we're seeing. There was all this hype and speculation about the Apple car for going on, roughly a decade. We're now seeing not just one but two big smartphone companies get involved in the EV sector in China. Before Xiaomi, it was Huawei, and I think this does speak to the sort of interest on the part of the Chinese consumer in technology. I think we've seen that for years with Tesla having real serious competition, and Elon Musk speaking very highly of the Chinese manufacturers. The fact that we've seen some of these companies in China that are seen as the sort of best of the best in terms of technology in the mobile phone sector, as they enter the car market, they sort of bring with them that goodwill and interest on the part of the consumer. And we've seen Huawei really blow the doors off in terms of expectations, and Xiaomi coming in right after and sort of replicating that success. So just based on what we've seen thus far out of these two companies, I think they're going to keep pressing the envelope there until they run into any resistance.
Can I just borrow a word of yours, Craig? Replicating. Can we just compare and contrast what's coming out of Xiaomi to the Model 3 in Tesla? These vehicles, Craig, they look very, very similar. What do you think is actually going on here?
I mean, I think they absolutely look similar. I think you even hear the executives talk about how they're sort of, looking to take on Tesla in a head-on fashion, comparing themselves with Porsche a little bit, which might be a little bit ambitious just given where they're pricing this vehicle, but they want to be seen as more upscale. You've seen, a lot of the competition against Tesla in China come in at lower prices. BYD in particular is really aggressive on a pricing front. But while I do think this model will sell for less than a lot of what Tesla sells, they are a little bit at a discount. But closer to Tesla than what we've seen out of some other companies. So they're going both for value and volume, as opposed to a lot of this competition. It's really sort of been a race to the bottom that we've seen, particularly I would say in the last 6 months.
Craig, appreciate it. Tied to the desk, waiting for those numbers to drop from Tesla. Craig Trudell there of Bloomberg. In our office in London, I cannot think, and I said this yesterday, of many sectors where the competition is as fierce as the auto sector in China right now.
That's the politically correct way of saying it, right? I mean, basically, the implication here is that potentially and historically, companies go to China and there's a concern about the intellectual property and what happens with that. And it raises this question of, okay, well, if companies are going to go back to China and do business, how much assurance do they have that their intellectual property will be secured?
That being said, it's quite the achievement for the smartphone company to develop the car they've developed, particularly the setback that Apple have had, and they ultimately threw in the white towel.
Which is the reason why I asked, what's the barrier to entry? Does this mean that it's a lot lower, or does it mean that there's something different going on with this company? Or are China markets really diverging dramatically from the U.S. market because there is a different incentive for the electric vehicle adoption than, say, in the United States?
Tesla right now negative in the pre-market by about 1.7%. Let's give an update on stories elsewhere. Here is your Bloomberg brief with Yahara Hakez. Hey, Yahara.
Hi, John. Disney is ahead in its proxy battle against Nelson Peltz's Trian partners, with more than half of all the votes cast, according to the Wall Street Journal. The paper says BlackRock and T. Rowe Price are among the major investors backing Disney. The Journal says investors are still casting votes and can change them through the annual meeting tomorrow. Peltz is seeking a board seat for himself and former Disney CFO Jay Rasulo. More job cuts at Citi. A fresh round of reductions at its investment bank saw managing directors in the technology, media, and telecom division, plus those covering equity capital markets, leave the Wall Street lender. The latest cuts coming as Citigroup says it's concluded the major actions around its reorganization plan, which aims to streamline operations by eliminating 20,000 roles. McKinsey has made a unique offer to some of its staff. Take 9 months' pay and go away. The management consulting firm is dangling the pay along with career coaching services to some UK staff who they would like to leave. The move is the latest personnel shakeup at the firm and comes shortly after it warned some U.S. consultants they were running out of time to get a promotion. That's your Bloomberg brief. John?
Yahara, thank you. So it's not just 9 months off and you can go back to the job. You've got to, leave.
Yeah, it's trying to encourage them. I like the way that they tried to shape this. We're encouraging them to move on to new things, to really challenge themselves.
It is kind of a nice way to get fired, though. They're going to trim headcount, likely, if no one takes this. So 9 months leave and then head out.
I thought this was a new European social program that I could get on board with, but apparently not. Sort of 9 months off, full pay.
Yeah, you want that?
Oh, totally, don't
you? As long as you have a job at the end of it.
I want a job at the end of it.
That's part of it.
Obviously.
Other than just nothing else.
Up next on this program, higher for longer.
My personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer.
That conversation up next.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, well, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The cross-asset price action is anything but boring right now. Earlier on this morning, in the last hour, new high for the year on a US 10-year, 434.91. Yields up 3 basis points this morning. In the commodity market, $85 on WTI. New highs for the year there on crude as well. And in the equity market, just inching lower yesterday, again this morning. We're down about 0.25%. Under surveillance this morning, higher for longer.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. My personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer.
Here's the latest this morning. Odds of a June rate cut dipping below 50% with plenty of data on deck. The jobs report due at 10 a.m. Eastern time today, ahead of Friday's main event, the March payrolls report. Abigail Watt of UBS writing, quote, "We expect an employment report that would exceed consensus expectations, yet we do not think that will derail the plan to dial back the restrictiveness of monetary policy at the June FOMC meeting." Abigail Watt, I'm pleased to say, is with us now to discuss. So, Abigail, before we look ahead, we need to look back just to yesterday and talk about that ISM manufacturing read. How much weight would you put on that number, those numbers out yesterday?
Yeah, so the ISM did come in a little bit stronger than we had projected yesterday. But I would say that when we look at the broad swath of manufacturing surveys from regional feds alongside that ISM print, we are seeing that generally those are remaining in contractionary territory. And actually a number of them worsened in March as well. So I think when we look across the broader kind of spectrum of data that we have for the manufacturing sector, we're still seeing quite a weak outturn in the manufacturing sector in the US.
This is actually really interesting to me, Abigail, because this is exactly what a lot of people were writing in notes that I read over the past couple of days, that they dismiss certain data points that we're all looking at as just simply aberrations with respect to the other data and don't really highlight something more than a bump in the road. What would give you pause that some of these hotter than expected prints are more than just a bump in the road?
I think what you'd be looking for is a corroboration of that signal, right? What you'd be looking for is the fact that you see a range of data coming in kind of hotter than expected. And also, I think, looking particularly at those data that matter the most to kind of policymakers. So looking at kind of the labor market data, looking at the data we're going to get later this week, seeing how that plays out, looking at the inflation data, focusing in on those metrics that we think are kind of front and center for policymakers as they head into the kind of monetary policy decisions in May and June.
One of the data points that we keep watching are the commodity sectors that have been on a tear, and a lot of people are pointing to that and saying, how much more evidence do you need that manufacturing is picking up around the world and that we are seeing that kind of robust activity percolating into copper, into even some of the precious metals, as well as, of course, into oil?
Yeah, I mean, if we look at the hard data, though, like if we look at the actual kind of manufacturing output is down year to date this year. We had two quite soft prints in January and February. And when we pair that with the idea that we're not necessarily seeing kind of a big pickup in maybe CapEx intentions and some of these survey-based measures, as I said, are still remaining in contraction. I do think when we look across the kind of broad spectrum of data, we're not necessarily seeing that kind of resurgence and kind of improvement in the manufacturing sector as yet in kind of some of those harder data too.
We put up a quote of yours, Abby, about 2 minutes ago, and you said this, and I want to repeat it. We do not think the recent data will derail the plan to dial back the restrictiveness of monetary policy. I want to talk about that R word because Bill Dudley said this. His personal opinion, monetary policy is not really exerting that much restraint on the economy. Can you just explain the divide between, say, you and a Bill Dudley at the moment?
I think there are pockets of the economy where you've certainly seen the impact of higher rates. For example, if we look at business investment through 2023, business investment was pretty weak through 2023. You saw kind of residential investment clearly hit by those higher rates. And I think as well, like, given the kind of headline strength we've seen in the consumer, I think one of the things that can be missed is where you are seeing signs of stress on the consumer side. And one of the things that we put in our new outlook that we published 2 weeks ago was that the kind of distribution of wealth across consumers, is unequal. And one of the things that we are seeing is that at the lower end of the income spectrum, you are seeing signs of stress. You're seeing kind of delinquencies rising on credit cards, on auto loans. And this is kind of also exacerbated by that return of student loan repayments. When we look at those kind of age groups that are more likely to have student loan debt, those are the age groups where you are seeing those delinquencies rising. So there is certainly kind of pockets of the consumer sector that are also feeling those higher rates.
Abigail, do you think that this Federal Reserve would be willing to cut rates to ease some of the pressure on those segments, even at the risk of allowing inflation to run higher for a lot longer?
I think the Fed have been really clear that they're looking for progress on inflation. And I think the thing that they'll be looking for is that continued progress. They have said that they don't necessarily need to see inflation return to 2% before they can begin to dial back the restrictiveness of policy. But it does feel like, given the kind of strength they've seen in the labor market, given the fact that they have seen we saw upward revisions to growth through Q4 last week, given the fact that they've seen that activity data as a whole remaining resilient, I think that does give them the space to kind of wait and see and digest that data before removing policy restrictiveness.
Lots more data through this week. Abigail, we've got to go. Abigail Watt there of UBS. Abigail, thank you. Looking ahead to that economic data, it starts with job openings later on this morning, 10 a.m. Eastern time. Going through to ADP, then on to jobless claims and on to payrolls on Friday. I'll share the estimate, just a sneak peek at a survey here at Bloomberg. The median estimate right now, 203,000 is the median estimate in our survey. As you know, that can move around. It can move about as we get more estimates going into Friday. The previous read was 275. And Lisa, I remember you said it last month going into payrolls. You were less interested in the current month's economic data and far more interested in the revisions, just to try to work out just how real, just how boomy January truly was.
And it wasn't as boomy as people previously thought, but it was pretty boomy based on historical standards. Again, this talks to this idea of there's plenty of strength. Have we priced it all in? Is it still continuing? And how do people explain it away as somehow being underwhelming and not inflationary whatsoever, because it's going to be simply one anecdote in the bump of the road that everybody wants to see?
It's hard to describe anything that comes in with a two-handle, 200 and something thousand as weak, as soft, as evidence of restraint at the Federal Reserve.
Which is the reason why I really think it's interesting. Abigail was talking about sort of lower income families that have been disproportionately hit. And that is a big concern. You just wonder, is this a more patient Fed that wants to prevent certain segments from get hit hard on that particular aspect of higher rates, even at the expense of waiting much longer?
A socially conscious Federal Reserve. I would say a socially conscious Chairman Powell. I think we saw a few hints of that in the pandemic. Coming up in the next hour on Bloomberg Surveillance, Troy Gajewski of FS Investment, Stephen Cook of CFR, Mark Chandler of Bannockburn, and Kathy Jones of Charles Schwab. That's next. This is Bloomberg.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, the electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Look at the fundamentals. I don't see earnings moving lower anytime soon.
The markets have already moved in the U.S. in tech. We want to be looking for the new areas of opportunity.
Anything that's kind of been deputized into AI has been driving the market. I think people are getting tired with the same story.
This broadening is a good sign of more confidence in the market.
I think this market wants to rotate, and it's starting to happen.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
We've got a lot to talk about in the second hour of Bloomberg Surveillance this morning. Live from New York City. Good morning for our audience worldwide. Your equity market on the S&P 500, a little bit softer yesterday, a little bit softer this morning. The levels elsewhere, though. New highs for the year on a US 10-year in the last hour this morning. That high is 434.91. New highs for the year in the commodity market, both on Brent and WTI. New record highs on gold. Lisa, gold on quite a streak.
Which is the reason why people are looking to that asset class maybe as a read on inflation and on the haven kind of trade more than bonds right now, given the fact that you haven't really seen as much nervousness expressed there. When you talk about this threshold of bonds continuing to sell off, at what point do people start to worry about both oil prices rising, a deficit heading into an election, and the fact that this is a Federal Reserve that's facing a lot of obstacles to cut rates as quickly as they wanted to?
A strong whiff of inflation on that board, that's for sure. Let's talk about it a little bit more. Brent crude very close to 90, in at around 89 this morning. WTI breaching 85, I think, for the first time since October. Hey, mate, you just keep going through the numbers. Repeatedly, commodities breaking out over the last few weeks.
Yeah, and what's so interesting about the oil market is you have three different dynamics at play. One, supply, OPEC plus cutting back reduction. Even overnight, we're hearing that Mexico is ratcheting back supply from their state-controlled oil company. Demand starting to pick up in places like China, and then the risk premium you're seeing of what happened yesterday in the Middle East. And this concern, given that Iran has come out and said there will be revenge on this strike at their consulate embassy in Damascus, that just means more upside potentially for crude.
Let's pick out one piece of that and talk about demand and what we've seen in the last couple of days. China, manufacturing expanding, the official read for the first time in 5 months. In the United States, seeing that expansion for the first time in 16 months. It's literally been a year and a half. And Lisa, you start to think about the economy, not maybe plateauing, but perhaps re-accelerating in certain parts, away from services and towards manufacturing.
I'm kind of sad I missed Jay Pulaski yesterday.
Jay was pretty solid.
I want to just, this is a quote from him. I have to share it. Everyone wants to talk Mag 7, Mag 7, Mag 6, Mag 5. I'm trying to do it. I'm not doing a very good job. Sorry, Jay. Commodities, people, it's really basic. It's supply and demand. So again, this is a reason why we keep asking, is this a symptom or is this a cause? Is this a symptom of the growth that is under the hood that could continue? Or is this going to be the cause of inflation that's going to hamper growth? This has always been the question. Are higher oil prices inflationary or disinflationary? Right now, what everyone said, music to my ears, it's inflationary, not disinflationary.
A reflection of the strength or a recipe to end the cycle? We'll see, but that's the debate we'll have this morning. Equity futures on the S&P 500 negative by 0.25%. On the S&P, yields are higher again by close to 4 basis points. Lisa, very close to 4.35 on the US 10-year. Those levels just won't go away.
And it's been this grind, and we've seen the grind continue. I went back to 2020 at the end of the year to see how much bonds have lost since then. They have not recovered ground. They are down 11% since then. It's this grind that raises this question, what happens if this Fed doesn't cut this year, or can only cut once? Do we start to really kind of reset with the idea of what is restrictive and what a neutral rate looks like for the foreseeable future?
Does President Bostic find some company on the FOMC? You mentioned that Kashkari's on Team Bostic, perhaps.
They're having lunch together.
Perhaps some others joined too. We cannot officially say they've had lunch together. That is the most TK thing I've ever heard.
You said that they were having lunch.
They had lunch in Jackson Hole, Wyoming last August.
Well, that's
I can
they
confirm.
lunch. Please write in. Kashkari, Neil.
I've got no idea how often they lunch.
How often do you lunch?
They can answer that question for themselves.
I think that they should answer it.
Coming up this hour, they should both come on this program. Troy Gayeski of FS Investments on why he's calling for a spring cleaning of portfolios. Stephen Cook of CFR on rising tensions between Israel and Iran. And Kathy Jones of Charles Schwab following a sell-off in US Treasuries. We begin with our top story. Stocks and bonds steady after strong factory data left traders pushing out rate cut bets once more. Troy Gayeski of FS Investments saying the performance of the US economy is an opportunity for a spring cleaning of portfolios, writing this: cash has been a great place to hang out for quite some time and still offers a positive real rate of return, but gradually deploying those massive cash hoards into a select group of alternative strategies can substantially increase return potential without having to take on uncomfortable levels of risk. Troy, I'm pleased to say, is with us now for more. Troy, we want to reflect on the data we've had so far this week, going into a week full of economic data, really concluding with payrolls on Friday morning. Would you see that data, that strength, as a good thing or a bad thing for risk assets?
Well, for risk assets, it still continues to be a good thing over the medium term in that stronger economic growth leads to more revenue, leads to lower default rates and credit. We're getting to that inflection point, though, where you had a violent enough curve move yesterday that equity markets finally paid attention, right? If you think of Q1, you had another quarter where fixed income was down, like a broken record, like we joke around about, but equities were able to power ahead because not only did you have very strong earnings, but obviously the economic growth surprises were relatively robust, and Powell started to jawbone about, some would say, premature cuts. So, we're at a more dangerous level in terms of valuations. But generally, that rebound in manufacturing should be looked at as a positive outcome and a positive driver.
Troy, you say the equity market started to wake up. I mean, I've got a question now. We were down 0.2% yesterday on the S&P. We're down 0.2% this morning. I think the equity market's still snoozing, isn't it?
Yeah, well, compared to previous higher rate-driven dislocations, I mean, the most recent one, of course, was August to October of last year, where you got a material curve move. And 0.2% is kind of a rounding error. But, at 21 times forward earnings, you just have to ask yourself, how much more upside do you have when so much of the good news is priced in? And to the points you've been making already, there's a material risk of substantially higher rates at the back end of the curve. We still are fairly inverted. The curve has obviously been gradually pricing out cuts this year. But bottom line is, to Lisa's point, in this scenario where there are no cuts, you have to think the back end of the curve is going higher, and we could retest the 5% level at some point, given the substantial supply that's coming on, and obviously a technical picture that's not terribly supportive.
Does 5% this year?
We have thought, and we still think that's definitely possible. I mean, look, the way, when you think of the forward reaction function for the Fed, right, we've always said that this cutting cycle is going to be the mirror image of the 15 to 18, or sorry, this hiking cycle is going to be the mirror image of the 15 to 18 cutting cycle. Very slow and steady. And there's a reasonable probability that as the Fed first starts to cut, the back end sells off as inflation expectations get anchored higher. In the event that they don't cut at all and they continue to pursue QT, which they still are, as you know, there's certainly a risk that we make higher highs this cycle. And that's one of the risks that markets have priced out, we think, far too fast, particularly late last year and early this year. So yeah, it's not that fixed income is tragic like it was in 2020, early 21, or late 21 as well. It's just that the risk reward still isn't fantastic like many people have been articulating it is.
I love the idea of fixed income as tragic, Troy. There is this question, though, about what assets get hit hardest. If a 10-year yield does climb back up to 5%, it starts to retest some of these levels. Is it just public equity markets, or is it also some of the private markets that have seen incredible amounts of cash flow in that are kind of pegged to floating rate types of instruments?
Yeah, so I think when you start with private credit as one example, which has been an area of tremendous growth and really very attractive positive returns, not only in 21 and 23, but also in 2022, where the index is up roughly 6 to 7% in a very tough year. So you're always rooting for higher front-end rates for longer, with the lowest probability of that tighter Fed policy cratering the economy. Right. And that's why when we first came up with this scenario last year, we called it the Dare to Dream scenario, because, from a probability standpoint, it was almost too good to be true. But of course, that is now the base case where the Fed has hiked a lot. They're keeping rates higher for longer, and the economy continues to be incredibly robust. However, to your point, if you get a high enough back end and financial conditions tighten enough, that could lead to slightly higher defaults over time. So you give back some of that excess income in the form of defaults. But so far, what we're seeing is very low default rates, the ability for companies to restructure with strong-handed both private equity and public equity partners. And that means less income being returned through defaults, which is really as good of a scenario as you could hope for in private credit markets.
I get the sense, and it's not just from you, Troy, but a lot of investment managers who come on say, cash, you're running out of time. You got to deploy it, whether it's alternatives, whether it's into other parts of the equity market, the, forgotten 493, as we heard earlier. Is there really a sort of pressure for time for cash? And no, I'm not just talking my own book, but there is this question of, if the Fed's going to hold rates higher for longer, and it doesn't seem like this is that restrictive, why couldn't you clip 5% on a money market fund for the foreseeable future?
Oh, yeah. Look, we've argued for the last 2 years, right, that what you want to focus on is Northwest Quadrant strategies that have higher returns with lower risk. And cash actually is one of those alternatives to traditional fixed income and also equities. However, when you look at where you are today, really 5.25, 5.5 is the peak, right? The probability of the Fed hiking from here has always been non-existent. It still is non-existent. So you only have one way to go, and that's lower. Now, as we've discussed, it's going to be very slow, very plodding, cutting cycle. So you'll still have income. But the question is, when you think of, whether you're looking at actuarial studies or what folks need to retire comfortably, typically you're in that high single digit to low teen range. And the question now is, should you at least gradually think about deploying, that extra $2.5 trillion in money markets, that extra $4 trillion in commercial bank deposits into strategies where you're not taking uncomfortable levels of risk. You're not going to walk into a potential 10 or 15% drawdown, or if you're in equities, or you're reaching for duration right now, as many have done the past 2 years, much to their chagrin, and you take a 5 to 7% duration-related drawdown, where you have you're conceding liquidity. You're going to have marginally more risk, but you're boosting your return potential to high single digits to low teens. And, one of the unique things about private credit now, which is really fascinating, is that you actually have potentially higher returns in the debt part of the capital structure than the equity part of the capital structure, right? Because that extra debt service payments that go to the lenders comes at the expense of free cash flow for a lot of mega cap LBO firms. So the equity forward returns there will be lower to the benefit of the debt holder. So it's an unusual period of market history for sure.
I love how Lisa talking her own book is standing cash. And for a lot of people, it's single names, right? But for Bramo, it's standing cash.
Look, I'm not,
showing my hand too much. Actually, carry on. We don't have to continue.
Sorry, I want to squeeze this in. Actually, it's a random question, so forgive me for this. The FT had a strange front page yesterday, and I'd love your thoughts on it. It was about the record supply, the bond issuance we had in the corporate debt market, and this really odd link about the election in the back end of this year. And I have to say, I hadn't even thought of that. Are we linking the boom in supply in the first quarter of 24 to the prospect of the market closing up in 4Q this year?
You know, I think that's a bridge too far. I think what's really happened here, again, in our investment committee meeting, we discussed that a lot of the explanatory variables for what's gone on in terms of market price action, as well as in terms of risk appetite, gets back to those huge cash hoards that the Fed created during, the pandemic and still lurk with us today. So what we've seen across the board, whether it's, middle market corporate lending, whether it's senior secured commercial real estate lending, whether it's high yield bonds or IG, and even agency pass-throughs, which really have the horrific technicals, is a gradual, steady, relentless tightening. And obviously issuers are taking advantage of that, and they're looking at the past 2 years and they're thinking the next 6 to 9 months forward. This is probably one of the better points to issue new debt and lock in new financing. Or just as critically, if you have a roll date coming, whether it's floating rate debt or fixed, this is the window you're getting. And if we do have turbulence at the back half of the year, you're probably getting better pricing now than, perhaps in Q4. But I think that's a stretch.
Very diplomatic, even calling it a stretch. Troy, thank you, sir. Troy Gaske of FS Investments. We'll see what we get in Q4. I certainly hadn't attributed what's happening in Q1 to what may happen later on this year. New note, Torsten Slok, Apollo, on payrolls. This to say, the bottom line is that the improvement we have seen in the labour market in January and February is real. Goes on to say, combined with low jobless claims, non-farm payrolls are likely to surprise to the upside again in March. The number we're looking for on Friday, something in and around 200K. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Boeing's bumpy year is being felt by pilots at United Airlines. The carrier has asked pilots to take unpaid time off next month as it grapples with delayed deliveries of new Boeing planes. The delivery delays have reduced the number of flying hours United had planned for its pilots this year. The staffing plan could be extended into the summer and potentially the fall. Rubrik, a cloud and data security startup backed by Microsoft, has filed for an IPO, disclosing growing revenue and losses. The size and price of Rubrik's planned share will be disclosed in a later filing. Its expected IPO follows trading debuts by Reddit and Astera Labs. The Iowa Hawkeyes are heading back to the Final Four after defending reigning champions, the LSU Tigers, 94-87. Iowa was led by star guard Caitlin Clark with a game-high 41 points. Tigers star Angel Reese finished with 17 points and 20 rebounds. Iowa is seeking its first title and will face the winner of the USC-UConn game on Friday. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, tensions rising between Israel and Iran.
This is probably the most senior person that's been killed since Soleimani during the Trump administration. And the easiest vector for Iran to respond with would be by attacking U.S. forces in the region. For now, it looks like the U.S. is probably going to be its main target.
That conversation up next, live from New York City. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
Could face bigger challenges next.
Fed was going to keep rate World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Equities on the S&P 500, a little bit lower, negative by 0.25% on the S&P. Crude up by 1.8%, $85 on WTI. Under surveillance this morning, rising tensions between Israel and Iran.
This is probably the most senior person that's been killed since Soleimani during the Trump administration. And the easiest vector for Iran to respond with would be by attacking U.S. forces in the region. And the other vector for escalation that's really the more worrisome one would be one of Iranian proxies like Hezbollah attacking Israel from the north.